for traders to watch?
I mean, the only barometer, you're playing tariff roulette. I mean, the thing is, I mean, I just don't, it's one of those, I mean, that's why I think Tom is so dissatisfied, is that instead of looking at a barometer, I mean, I guess the only other barometer is the degree to which the bond market is comfortable with the madness. And it's like it's either you're dealing with the bond market and its comfort with the madness, or you're dealing with Trump roulette. And I guess the question then becomes, well, is the bond market comfortable with Trump roulette?
Clearly not. I mean, last night their bonds were down in the 110, 111. I mean,
not to mention the U.S. dollar.
Yeah, and you have bond volatility at like historic highs. It's clear that, the volatility is spilling into basically everything right now. It's meme stock. It's the U.S. markets have become meme type trading, which is great for opportunity and for traders. I've been saying it all year long. It's like you can have stuff in profits in the matter of hours. I mean, it's amazing.
Yeah, for traders it's great if you're nimble. For non-traders, it's pretty horrific for the implications.
Yes.
Right? So, that's like the square I'm circling. It's like, oh, great, this was a really good day today. Oh gosh, if it's a good day for me, then it's because I have a pretty dour view on things, and that's probably not good. Nick, you mentioned the bonds having historic volatility here. Usually when we think about, at least as far as I can remember, Dylan, we've talked about looking at the long end of the curve. We frequently mention that maybe TLT is the place to go instead of ZB, because ZB has been the portion of the curve where there's been higher relative volatility. That's not the case right now. ZN actually has the higher relative vol, 95.2 IVR compared to that high 70s reading you see in ZB. For those who don't really trade futures, ZN has a tick value of $15.62.5. For ZB, it's double that at $31.25. And it's also half the overnight buying requirement. So for the average retail trader, right, you can take a look at ZN, perhaps in a different way than you would ZB, and not have to go over to an equivalent ETF product. But there is a potential turn here today in the 10s, Nick. The uptrend from the yearly lows that we see here in January and February, now here in April, it is holding up. It's an area where the market previously peaked out. So what do we do? I'm directionally neutral right now, but if you think people are looking at bonds, is this a place where we could potentially sell some puts against recent swing low, or do you need to move further out because of how memeified the U.S. Treasury bond market has become over the past 2 weeks?
I mean, Trump's harped on rates coming down, and specifically the 10-year rate. So, you would think that would be the easy trade, but it hasn't played out at all. So, I mean, yeah, with volatility this high, I certainly think puts are, short puts are on the table here. But again, I think if the market was feeling more certain, for lack of better words, you'd see that, you'd see 10-year yields much lower. Like that would already be in the cards. I mean, you have rate cuts coming. What do they have? At least 2 for this year. I think they have maybe a third in there. I mean, bonds can't be here if they're going to move rates that much. That's just, that's just the situation.
Dylan, our resident bond enthusiast, Ilya, isn't here, so we'll speak in his stead. So am I, to a certain extent, but Ilya's been out here on every single debt buying TLT, like left and right.
For
Dylan,
sure.
What do you think about bonds here? I mean, this is obviously I find this situation very unique. Not very unique. I hope Josh Fabian isn't listening. He hates when I say that. Always sends me a message whenever I say that. It's a redundant. No point in saying very unique. I digress. This situation in and of itself, you presume when you go back to like economic or corporate finance theory, there's a risk-free rate. It's U.S. Treasuries. The market's behaving as if that it's really not a risk-free rate anymore, that there's some layer of additional...
No, it's behaving like more and more like an emerging piece of emerging market debt.
Yeah, right. So should we treat bonds with the typical
let's just
methodology?
Be prudent, right? If you believe America is too big to fail, which I do, and if you believe that a recession is underway or a meaningful global slowdown is underway, which I believe, then the only possible option is for rates to come down eventually. That's a bunch of facts that are easily sort of, I can get consent from 9 out of 10, reasonably well-educated financial individuals. On the other hand, the dollar's in a free fall. It's and the bond is while it may have reduced interest rate risk, to use an Ilya term, it has substantially increased term premium, as he likes to say, as a reflection of underlying structural policy risk in the United States as a direct result of a new economic policy regime that has been consolidated into the hands of a single individual by use of so-called emergency powers, which is preposterous. But when you have a single individual consolidate influence in a preposterous manner under the guise of emergency powers while in custody of the largest and most powerful economy in the history of the world, it makes sense that term premium in the bond market would go up, that the currency would become less valuable, and that the economy would slow down globally. And so the reason not to buy bonds was because of the term premium increase as an offsetting factor to the natural rally in bonds, which should occur in a declining rate environment, which should be the natural result of a slowing economy.
Nick, I find the dollar having a really serious illness to it right now, which I call narrative inflexibility. Right? Over the past several years, you've seen gold and you've seen Bitcoin at times have this immense narrative flexibility. It's going up because it's a hedge against inflation. It's a hedge against geopolitical risks. It's a hedge against sovereign stupidity and inflating debts and deficits, right? Central banks are buying it, right? The dollar doesn't have that. I mean, a day like today, the dollar's been getting killed as yields are going up, as stocks are coming down. That screams sovereign risk is coming in. People are repricing the U.S. economy in totality. They're giving it a different multiple countrywide. Today, yields are down, stocks are up, and the dollar's still falling. That's that inflexibility here. When yields are up, it's because it's sovereign credit risk. When yields are down, well, interest rate differentials are moving against it. That's kind of like a spiral it's in at the moment. And I think for me, I really like things that have the positive narrative flexibility, where you can basically make up a reason and it's going to go up. Right now, all the things that should be helping the dollar are hurting it and vice versa. So do you have any particular view on currencies at these levels? I know you're not a big currency guy like Ilya, but you surely have to see something like this in the dollar and have an opinion on it by now, right?
Yeah, I certainly can't fill Ilya's boots there with his knowledge, but I will say, to Dylan's point of, is the U.S. too big to fail? If you are on that side, you have to be short some of these currencies. I have some short delta in the micro euro contracts, just given the move that it's had.
You're saying long dollar just on the extremity.
Yeah, just on the fact that the U.S. isn't going anywhere and that this will resolve at some point. You have to imagine that if the chaos ends, the dollar goes much higher, and there's got to be, at least if you're going to be short equities or short volatility in equities, being short euro is a hedge against those two positions. I mean, you would think that
you're saying, so basically, if you internalize my base premise, which is America's too big to fail, you must be long the dollar at this moment. But then, do you agree then with Ilya? You also would you also give long the bond for this TL by the DXY or some version, whatever it is? I don't really care the instrument, and also buy the bond.
Yeah, I mean, I think you get long bonds because rate cuts have been telegraphed, and that is, that's coming. I think if you're going to have a U.S. recession and that's your call for bonds to be going up and obviously rates to be coming down, and you're short the dollar into a U.S. recession, if the U.S. is in a recession, everybody else is in a recession. It's all move. It's
for
not.
Sure, that's true. Yeah.
So like I just don't see the narrative, and I've had this conversation with Chris, a couple weeks back when the whole when everything started to pop off, and he was sending me all these things about the EU putting 500 billion into defense spending and all this other stuff.
Catastrophic text messaging. I've been there.
It's like.
The euro's up 6% over those few weeks, guys.
Okay, you got it. You caught the euro there, but that doesn't scare me that the EU is putting 500 billion into defense. That's not world changing for the US's outlook as a world superpower. Sorry.
True.
Have you ever seen a German drone army?
No, I haven't. Are they around Italy?
No one else has either, and there's a reason they don't want to.
Dylan, my concern is that the best thing that's been helping power equity markets higher has been the U.S. premium to the rest of the world, that you really have no other alternatives. I, for years, have said, you got Brexit in the UK and deindustrializing Germany, and France is France, and, Spain and Italy take naps in the middle of the day. So, do you trust these people to lead productivity booms anytime soon? What about the demographic declines of South Korea and Japan? But there was no alternative. The TINA trade's dead. And I think that's the key.
I think that's debatable. I think that maybe the world would like that to be true. And there's a huge amount of momentum with law firms and accounting firms and businesses to try to make that true. But just because the CEOs want it to be true, or the law firms and the accounting firms are trying to figure out how to make it true, and just because there's a good reason for it to be true, doesn't actually mean that it's going to be true.
That is very fair. Guys, let's talk about some of these winners.
And so why not buy how about this? We buy the bond, we buy the dollar, we buy the Mag 7. Trump tariffs are not going to, this is never going to play out the way that they're yammering about it. It's a joke. Mm-hmm. And this will be one of the, just like every other buy the dip opportunity, this is going to be one of the greatest buy the dips in the history of mankind.
I wonder, that's a pretty patriotic trade there, Dylan. What's the highest tariff good in the country right now?
I don't know. Something from Pinduoduo?
How would we know?
Timu?
I'm just thinking, Dylan, here's how you can really step up the patriotism. Not only do you get long the dollar, the Mag 7, and the bond, but to help pad the tax revenues of the U.S. government, you import the highest tariff good out there. And I think right here it says synthetic, non-electric synthetic blankets and rugs, subject to a tariff rate of 77.5% right now. Although, Dylan, tobacco has a pretty high tariff rate from outside the country at 350%. So if you really want to help, you can import tobacco into America, buy the dollar, the Mag 7, and bonds. That, of course, is not investment advice.
It's called the True Believers Port. That's not Madman's Delight. That's the True Believers portfolio.
Okay, we'll call that the True Believers portfolio, importing tobacco to give the U.S. government extra tax dollars.
Look at Philip Morris. Philip Morris is like one of the best performing stocks through this whole thing. So,
well, that's actually where I did want to go with this next, because I wanted to talk about the winners and the people who survived
recession.
today.
I'm sorry. Go ahead.
Yeah, cigarettes and McDonald's, baby. You get Philip Morris, McDonald's. Look at Walmart.
Yeah,
Walmart's back to highs.
That's pure consumer staples. Risk off, end of the world, blah, blah, blah.
Yes. We're going to stay home. We're going to eat our McDonald's.
And smoke.
And smoke. Yeah. And the reason why we're not worried about any of that is because we have great companies like Eli Lilly with GLP-1 drugs, right? It obviously hasn't done anything recently. Sure. But, there's your American dream portfolio, Dylan. McDonald's, Philip Morris, Eli Lilly, Walmart. Okay, and maybe throw Palantir in there too. They scored a defense contract today from NATO. They were up 4.6% and starting to break out a little bit here. But I think that's ultimately the point. If we're looking for long delta exposure in this market, it's the names that survive the downfall and bounce back quickly, the stuff that if we are heading into recession, the recession-proof sector, and I use that with quotations, nothing truly is recession-proof. But the recession-proof sectors would be something that people are going to have to spend money on anyway. It's the fixed things, the toilet paper, the bottled water, the electricity that goes into your home, utilities, like what we've been talking about for months. And Exelon, Nick, you've heard my rants about this
Yes.
company on and off for weeks and months now, but it continues to just push higher. But that's, again, utility. So consumer defensive and utilities and healthcare are the leadership group in these markets. Nick, is there a name there from a Walmart, a Costco, a Procter & Gamble, Clorox, Philip Morris, Coca-Cola, Pepsi? You know those names. Eli Lilly, Johnson & Johnson. Is there something that you like to go bargain hunting in some of these more stable guys over the past week or two?
Oof. That's a good question. I haven't really been trading a lot of those. I mean, I've been looking at, obviously the Mag 7 has been my focus, but some of the tariff situation for the semiconductor space makes the idea of being long Intel somewhat interesting. I also like ASML, which is a company that I've tried to get you on that makes
and they have earnings this week.
They have earnings this week, and they make the massive fabricators that are needed to make these chips. And they basically have a monopoly on it. But the idea that we're going to move some of that stuff here, and even TSM too, but I think Intel obviously is the speculative name of that bunch. But I think that's interesting because I think they're obviously, after this whole situation, there needs to be more of that production at home here, and so that, I think that story is still, is still in play. I don't think, like, when all the tariff situation gets rolled back and it's basically a nothing burger, I think that's one thing that actually sticks is the chip production, because all the AI and all the like all that stuff has to be repatriated here, or at least patriated in the first place here.
The Trump administration just announced that it's starting its semiconductor and pharmaceutical probe ahead of the pledged Trump tariff. So that is like the first step before they would go in that direction. That's nice. We had, 3 hours in between tariff headlines today?
I think he's live right now, isn't he? I thought we were getting back to that. I was hoping, you see, the difference is if the market reacted positively to the tariff news, we'd be back to the daily Trump briefing, the market
style.
Yeah, the market on close, like, your fake news, taking questions, like we would have had that, but because the market went down, we don't get that joy. Yeah, we don't get that joy.
That'd be such a funny Trump show at like 4 Eastern every day called Your Fake News.
Yes.
He would love that. Like if he just turned being president into his own streaming cable show as a daily, a 4 p.m. He would love that.
Interesting idea.
Yeah. Well, he's better suited for that than he is to be the president.
It's fair.
Nick, you were wading into the river of the.
He'd be great as an afternoon cable news host.
Dylan, he is one right now.
Yeah, basically, yes.
He's the best in the world.
Just from the Oval. So we have TSM here, Nick. It feels like obviously the semiconductors, the guidance is going to be an absolute. I think everyone knows the guidance is going to be bad. How could they say anything? They don't know what the tariff rates are going to be moving forward. But you have ASML and TSM this week. You've obviously liked ASML. Do you have any specific options, ideas, or strategies around the particular releases? TSM has a 55.2 IVR. ASML is 58.7. I'm a little surprised. I thought those vol levels would be higher still. They've come in quite a bit ahead of these earnings.
I think you got to go to SMH and just play the whole space. I think that's the easier trade. TSM is a little bit more tradable. ASML is not really all that tradable. It's a 650-ish. What do we close at today? 672. It's a tough one to trade. It's not the most liquid, but I think that story is one to be, like everybody is down on the semiconductors because of the tariff situation. I think the story becomes, bringing that here. And I think that's ultimately, an upside play here. Like, how do you not? That's the next big thing. I mean, it has to be, we have to own that from start to finish. And so I think that's the trade. A little bit longer duration so we can have time to figure out all this tariff stuff.
Yeah, I mean, that's like the heart of it, right? Factories just don't grow out of the ground. They take
3 to 5 years. 3 to 5 years. That's why the factories that were built 3 to 5 years ago are the unique beneficiaries.
Well, I think people forget how significant of a problem this is. What was it in 2017 or 2018? Elon Musk, to get around the permitting laws, constructed a temporary structure outside of the Fremont factory in California. And they were able to expand their production line in the span of a few months. Whereas if they had to go through the typical, constructing a non-temporary, a permanent structure, it would have taken years for them to do it. And so there are significant issues with trying to start a factory in this country. Capital aside, having had some interesting conversations over the weekend with various individuals, talking around to, venture capitalists like, would you be interested in, doing something here? They're like, no, our fund's down 35% year to date. We have no money to splash around right now. So who's going to fund it all? But I think we need the runway, Nick, is the point. You need some sort of transition. And if you're going to bring the jobs back home, this has to be ironclad policy. And the fact that it's executive order is going to give no business any confidence to make that move, because the next president could just snap their fingers and undo all of it. If they want to make it a long-term policy, Congress has got to pass a law to encourage the change in tax policy to permanently re-incentivize reshoring here at home. But reshoring of things that, not like shoes. What did Dave Chappelle say? I don't want those jobs. We don't want our kids stitching shoes here. Tesla's a different story, though. 252 today. Volatility has come off the board here as well. Nick, we have a nice little base of support under 225 or so. Elon has taken a step back, it feels like, in the public eye. Ever since tariffs came into effect, Doge has really quieted down a bit. Mm-hmm. Is that good for Tesla?
Did the breakup of the first man and the president, did that happen already, Dylan?
The first man. Jeez.
The first, the either or. Is that on the horizon here soon?
At the cabinet meeting last week, he was referring to Elon Musk in the past tense a lot.
Yeah, but they were together at the UFC fight this weekend.
Yeah, but Elon did a great job with Doge. Whereas in the past, he's been saying Elon's doing a great job with Doge. Again, he said that he's leaving in May. It's next month.
Yeah.
So it wouldn't be shocking, but
I don't know if it's good, but to answer I don't know that it is good for Tesla. I believe that there is, I don't know if it's permanent damage, but I believe that there's meaningful, ongoing reputational and brand damage to Tesla. I can certainly say anecdotally in Europe, whether it's in Milan or in Paris or in Rome or in London, where a lot of the Ubers are Teslas, or a lot of the Teslas are in the mix, that general sentiment is very Tesla sucks and F Tesla. Now, maybe that goes away very quickly, but I just think that Elon's position as the primary advocate of Trump and Trump as the primary sort of adversary of the world has left Tesla with a different brand image than it had 3 months ago.
All he needs to do is flip XAI into Tesla, and it becomes an AI company, right, Nick? I mean, isn't that something that keeps a floor underneath all of this, that Elon could just play musical chairs with his financial assets and reshape the narrative formally that Tesla has going for it right now?
I think ultimately him going back to Tesla and kind of being out of the spotlight a little bit in terms of in the government will be good for Tesla stock. I agree with Dylan in that there's been a lot of damage done, and I don't think it ends, because he obviously still has his microphone on Twitter where he can continue stirring the pot a little bit. But I think ultimately, yes, I think it is a bullish thing for Tesla to have him back and have him out of the spotlight. I just don't think long term you can, at this point with the move that you've had with Tesla, I don't know how you can not play the upside from here. I still see velocity of risk to the upside in a Tesla, especially if you're bullish the market and you think, maybe the tariff situation ends soon, all that sort of stuff kind of dies down, I think Tesla is your play to the upside because, we've seen this story before with Tesla. It has that, cult following that can flip on a dime.
57.9 IVR right now. Technicals may not be much of a guide here at the moment, but it's consolidating in some sort of triangle, perhaps, maybe not. But that's like a coiling spring. Nick, it's only a 57.9 IVR. Maybe the prudent thing here to do with Tesla is something like a reverse iron fly and just look for a volatility expansion, like price to move away from these levels. We're not going to chop around at 250 forever, are we?
I mean, Dylan, for a month you were talking about short put spreads in Tesla. I mean, that must have been the easiest trade of all time.
I'm still there, brother. I'm still there. I'm not saying it's going lower. I just don't know that there's a lot of upside in it. I like the put spreads. I like selling the put spreads. I like it.
I don't know. I get the sentiment towards his political nature, but when you watch those rockets land on those little tiny chopsticks, how do you fade that? How do you sell that? Like, that is better than anything in the $500 billion that whatever country is allocating to whatever. That is incredible. That's the greatest.
That's just because you have not yet seen the German drone army.
That's it's true. It's true. I saw the ones in China though that they do like in the sky during all the festivals and stuff. Right? Those are pretty awesome. I mean, that's pretty cool.
That's pretty cool. Have you seen the robot horse that somebody was? There's something like the robot horse, like you can ride it's like a robotic horse you can ride. It's sort of like a Star Wars vibe. Have you seen that?
Yeah,
like Empire Strikes Back.
I thought it was a dog, the robot dog.
Yeah. Well, yeah, maybe it's a giant dog, but you can ride it like a motorcycle, basically, except for it runs.
See, I'm here for that sort of innovation, Dylan. That's the sort of thing I support.
That's why the people watch Overtime to learn about the robot dog. There you go. That's what I'm talking. Look at this. That's why I work with Chris Vecchio. This guy.
Oh,
they don't call him Mr. Citation for nothing. Can you play that video? This is just unbelievable.
This is actually just a zoom in button.
Still.
But
okay.
But I mean, anyway, that's Terminator style. I like that.
Anyway, all the more reason to sell yourself with some Tesla put spreads and assume that at least the floor is it. At least it's not going lower. How about that? Do we agree to that?
I agree. I
just don't know if it's going higher. I think it's a bit of a mess.
Yeah. Well, I mean, no, it certainly is a mess.
It hinges on the bond market, right? It hinges on the bond market not challenging. Because the bond market here is telling you I think last week, and we discussed this last week, it seems like it's a very clear story. We've long said that the Trump put, if there is one, is not in SPY, it's going to be in TLT. Given the administration talking about detox and a transition and the need for refinancing the debt at a lower rate and the need for lower rates for consumers and businesses and yada, yada, yada. They've also said they don't look at the stock market and they don't care about stocks. So, it doesn't take a genius to put those things together and go, maybe they don't care about stocks this time around. Maybe they care about something else. For now is a very interesting point of view, Nick, because there was a poll released today, and polls are released every day. But this one specifically asked what Americans' number one concerns were. The number one concern for our consumers now is, at 70% of respondents, is tariffs. It's actually risen to tie immigration as the top concern among voters these days. Eggs were their own line item in the survey. There's like 65% of people are concerned about eggs. Eggs have come down. I'm actually had too many eggs in my house. In fact, when the prices started coming down, I was like clearing out my shelf. Like, oh God, I got to eat 60 eggs this week. This is a nightmare. So egg prices have come down. That's the good news. Gas prices have come down for maybe bad reasons. But we have a line in the sand here for bonds where the market and the American people are clearly indicating not a fan of tariffs. So if you continue to plod forward, maybe more funds blow up. Scott Bessent is out here speaking right now, the Treasury Secretary. The comment that obviously is going to draw a lot of people's attention is that he said he's thinking about a successor for Fed's Powell. We'll start interviewing candidates in the fall. That I don't think is the important one. I think the important one is that in his conversations with foreign governments and treasury secretaries, that they said that they were not selling U.S. debt on a sovereign level. And I think that further, Bessent's a tough guy to take at his word right now, as are all the administration officials, given how Trump seemingly contradicts any single one of them at, the turn of a dime. But if Bessent's telling the truth, then this substantiates the rumors that this is a Japanese funds, 2 of them blowing up with the basis trade last week. And that turn in the bond market with Trump saying that he himself was looking at the bonds on Wednesday at 12:01 a.m. I mean, you can trade against those lows. If bonds are holding these lows, we probably have a floor in everything else in the short term. This is the most important chart in the world right now. It's the only thing you should look at, in part because I want to feel less lonely when I look at it for the 17 or 18 hours a day that I'm awake. But this is the most important chart in the world right now, Nick. Would you disagree?
First of all, you got to love that he's at least looking at the bond market and acknowledging that he is, as well as the stock market. That's always fun to have. Yeah, I mean, I think the bonds are obviously important, and they've kind of dictated the move the following day in the market. Like, we had kind of that weakness in the bonds in the over the weekend. They started rallying in the morning, and that was kind of where the market kind of turned around. So yeah, I think you have to watch the bonds. I mean, they're moving. You got to watch them.
Dylan, you're looking at long bonds. I'm looking at long bonds. Notes are bumping up here. This is such a difficult question to ask. What's your favorite trade this week, knowing that we still have 4 full trading sessions ahead?
I think that the madman trade would be long dollar, just on price extreme. Basically, that the dollars has had an extraordinary move, especially for considering it's a currency move. It's not a meme stock. And, short the Canadian dollar, short euro, around the horn. I would say that would be the most aggressive trade that could be a very lucrative this week.
Nick, what's your alpha?
What's that?
Sorry to step on it. Go ahead.
No. That's good. I'm happy to leave it at that for the moment.
I like that. You've come to the dark side. I think volatility. I think you got to play. I think there's more volatility here, and I think volatility is going to be sticky. So I think if we open higher tomorrow, maybe looking at some long volatility on shorter durations is an interesting play. I think a lot of people are in the boat that, when this is done, volatility is back in the teens, and I just don't see that happening. So I think when volatility is getting into like the low 20s and we have the futures expiring this week. So,
yes,
we're going to be rolling into May volatility, which is currently sitting at about 30 and change here. I think volatility is going to be an interesting play. Two-sided action volatility.
From what sense? Long or short volatility for the week, I mean.
I think if we open flat to up tomorrow and volatility comes in, I think that's where you start to look at some long volatility. I got long volatility in the last hour of the session today, so I'm a little early, but I think that the low 20 handle in volatility is kind of where where we should look at being long it.
Isn't the long-term average of the VIX like 19, Nick?
Yes.
That's a normal market, right? And you're thinking when you have a 19 VIX, you're like, what? We're going to move 1.2%?
Yeah. 1% a day is a 19 VIX, a little bit over 1%. So
right,
I think
it's not a weaker dollar a corollary of a rise in volatility.
And if we,
yes.
Again, it's all being one trade right now. I would question if we get down to like a 24 VIX, call it like 1.5% move per day. Is that a reasonable floor for vol right now in this environment? I mean, if the VIX for some reason we woke up tomorrow, the VIX was at 12, I would probably back up the truck and buy as much volatility as I could in the market. right? We're now priced into under a 2% daily move at a 30.89. I think, Nick, you're onto something here. I mean, are we going to go back to where we were pre-Liberation Day?
I don't know if we will, but it's clearly a cheap shot to take given where volatility is right now. I mean, volatility is coming very, very significantly over the last week, and it's still, there's nothing really has changed, right? We had like a little bit of a relief rally on the tech news. We had, the time to buy tweet, which was great, and was a perfect time. He has choreographed exactly what you should do. He said, we're rates are going to come down, time to buy, all that stuff, has kind of come to fruition. But yeah, I mean, like, I don't think anything has really changed. I think volatility, the rate of change of what can happen with what he says or tariffs or that volatility should be high, is higher IV than what the market is currently at. Like the volatility of what could be said from the White House is way higher than current market implied volatility, I think.
I think I'm with you. It feels like today, this was a little bit understated relative to what was actually going on in the background. I mean, I said this earlier, but it feels like we're back in the seriously but not literally type of attitude that the market has towards Trump. Like, yeah, he's going to do tariffs, but like, is he really going to do the tariffs to the degree that he says he's going to? Mm-hmm. Because the effective tariff rate today is still in the high 20 or mid 20s right now. After all is said and done after the weekend, the effective tariff rate in the U.S. based on the 2024 import levels is close to 24%. Last week it was 27%. Even with the carve-outs that we just heard about, or maybe they're not carve-outs because the administration contradicted itself. Nick, you mentioned looking for maybe a little bit more vol coming back into play here, eyeing up something like what that reverse iron fly would look like in Tesla. If we were to go out 46 days, buying the 250 call and put, selling the 200 put, selling the 300 call, 65% probability of profit, risking up a little bit more than 2 to make 1. It takes a lot of buying power though, which is the problem with the perching trades like this. And quite frankly, the market's closed, so you'll see liquidity levels change. But we have to think about playing for vol, right? As opposed to necessarily in equities, at least I think, as opposed to looking to fade it, because we've already faded it quite a little bit here. And structurally, is 1.5% daily move reasonable in this market? We're getting into that zone. I've been using the high vol in the bonds. I'm directionally neutral in notes. I still have short put spread on in ZB. That's a little less worse today. Gold came in a little bit, but not significantly. I don't see any reason to make a position adjustment here, but one place to look, I would point out right now, copper, and this is certainly on my radar. I didn't get filled earlier when I was trying to get my entry in when we touched that 1 month moving average, although I'm going to take a second swipe at it again once the futures market reopens for the Tuesday session. We're basically halfway between the yearly high and low here in the copper futures contract. Volatility is fairly high. There's a little error with HG, but if you go to CPER, which is the effectively ETF commodity index fund equivalent, you're looking at an IV of 76. So flipping back to copper, putting on something like a short iron condor trade against the yearly high and low that we've carved out in the past 3 weeks seems a way to harvest the volatility here in something that's uncorrelated to other equity positions right now, broadly speaking. That's probably my best bet here for the next few days, aside from looking at some of those staples like a Coca-Cola or Pepsi, or even going back into the pit or the well of the individual energy names like an Exelon or Duke, for example, which I've been talking about for quite some time here. The things that are holding up throughout all this, now that we've moved it away from like correlation 1 liquidation to raise capital, I think that's where the best bets for long deltas are right now, because you're not going to have the tariff whiplash here, right? You don't have this uncertainty hanging over the head of Coca-Cola right now. People are still going to drink their soda like it or not.
Yes. Westwater owes me some money. He made me, or at least he had some sway in my capitulation of a long copper position. He had a great little piece on the copper gold ratio, and saying that the gold move usually continues, which it did. But I was also long copper there at that point, and that hasn't moved, or that has bounced, not as much as gold. But I closed out of that, so I'm gonna have to get that from him when I see him tomorrow.
There have been a few ratios that have blown out here. Dylan, before I go back to you, Nick, what do you make of what's happening in gold and silver? That ratio topped 104 in the spot market a few days ago. Gold-silver ratios aren't, you look through history, you're talking about these ratios in times of war and duress.
Yeah.
This is an extreme.
I traded long silver and I closed out of it last week, so I missed this big move. But it was a good trade at that point. I have slightly short delta in gold, playing into the upside skew there and just the volatility that you have. I have a wide broken wing butterfly in gold futures. I think it's an interesting trade right now just because you can get super, super wide because the skew is just so off the charts there and volatility is so high. So I think that's kind of an interesting way to be not short gold, but directionally looking for a little bit of sideways move there and have no risk to the downside, obviously. So that's how I've been playing the metals. I was long silver with this big wide butterfly, broken wing butterfly in gold, and I took off the silver last week. So my gold position is I'm still holding on to.
Still a good bit of vol here in gold, 73.5. Yeah, we're having a bounce back in the metals. One thing that throws me for a loop, and you kind of got to throw away your previous plans for much of the past year or two. Higher vol, good for silver, good for gold. Obviously, vol spikes during the sharp sell-off last week, and as we've been rebounding here a bit, vol has been starting to come back in. For gold prices, that might be problematic. Typically, receding vol has been one of the precursors to the market capping out. But if we do have this receding vol in gold, and maybe prices slow down or pull back a bit, good news for stocks, good news for bonds. You don't need to hold a shiny rock that doesn't produce anything in the future. It just stays a shiny rock, and you can bet on the innovation of American companies. I like your broken wing butterfly play here. I've just been rolling them up long in gold and silver. Dylan,
you've been right. You've been right. So I give you props on that, my friend.
I saw today that officially at one point today, the spot gold was up 1,000% since the turn of the millennia, which over the same time horizon, the S&P 500's up in the neighborhood of like 425%. Wow. Which is, who would have thunk it? Dylan, your most controversial take on the state of markets right now, which I think is a decent bar to set. You talked about MAGA Maoism earlier. What's the thing that's worrying you the most as an investor, as a trader?
No, I mean, actually, the thought that I was having was that maybe the worst is behind us. That the reason that basically now the market knows that Trump is the market knows what Trump is. The market knows what Trump's cabinet is. And the market believes, I think maybe correctly, that the bond market is the ultimate master of Trump and his cabinet. And that as long as the bond market disciplines Trump and his cabinet, that they're not going to, that whatever they do in the future won't be as crazy as what they've done in the last 2 weeks, and that it gets better from here. And that actually there's a reason volatility is coming in, and there's a reason the dollar is going to get better, and there's a reason why owning stocks might be this is a good entry point, because it's impossible for the Trump administration to behave more insane than they have already.
Counterpoint, Nick?
No, I was going to say, how many times have we said that over the last couple of weeks? It can't get any more crazy.
He said, "What's my most controversial opinion, Nick?"
I know. I like
it's controversial to suggest that that's it, baby. Here you go.
I like it.
This is your crazy monkey. Do with it what you will.
Yeah,
that time is going to come, though. I don't know if it's right now. That time's going to come soon.
Much to consider. Well, we have all week long to do it. It's going to be another long week. Thanks for tuning in, of course, for overtime again. And of course, your continued presence here, supporting us on Tasty Live. With that, overtime's out of time, so we'll see everyone same time, same place, every Monday through Thursday, right after last call, 4 p.m. Eastern, 3 Central. So for Dylan Radigan in Milan, Nick Batista in Chicago, I've been Chris Vecchio in New York. After this brief break, more Tasty Live coming at you next.
Liberation Day is here. How do you feel? We're going to discuss about how the markets feel and what they may do with this information tomorrow. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we'll do is go through where the markets were ahead of the news that we had today. Obviously, everybody was waiting with bated breath for the tariff announcement coming from the Rose Garden of the White House today. The hope was that we'd get some kind of certainty and the markets can unclench. And then we'll take a look at what this might mean going forward, because we do have some economic data to offer a nice little follow-on lens from which to look at all of what is going to happen next. So let's break this down. Here was the S&P 500 going into the close. This is before the after-hours action. Of course, we had the announcement come after the cash equity close. And as we can see here, the markets were not in any kind of panic. And we can see that here and reason that then our logic, as we've discussed it here on Macro Money over the past really months, has broadly borne out, which is to say that the markets are not afraid of tariffs. They knew about these tariffs back in November, or at least the concept that there were tariffs that were coming. The markets only really became unnerved by all of this here in the middle to late part of February. And of course, naturally, the question comes, well, if the markets don't like tariffs in general, where were they on them here, where clearly there was not a period of consternation? Why here? And it's the same story here as we were going into this announcement. What the markets wanted really wasn't a canceling of the tariffs, because clearly they knew that they were coming and they were not going to sell off on that realization alone. It's a similar story for the bonds. We see here that we have interest rates actually going up in the immediate aftermath of the election, basically saying, okay, well, we're going to have tariffs. They might increase prices a bit. Maybe interest rates need to go up some, but the economy is also doing relatively okay. And that probably is broadly a little bit more inflationary. So maybe it means the Fed needs to cut rates a little bit more. Not until or a little bit fewer times, but the cuts are maintenance cuts, and what this ultimately is going to be is not anything terribly detrimental for the overall business cycle. Obviously, that's changed, and of course, stocks reflect this as well. We've seen a much more dovish view on what was expected, but in any case, today, again, ahead of the announcement, no panic. Just a sense that, okay, maybe we'll get to the clarity, and maybe that clarity will unwind this, or help to unwind it, and this. Because really, that seems to be the reason the markets are annoyed. If they weren't annoyed in November, What got them annoyed here isn't that the tariffs are coming, it is how they are coming. And the evidence that their arrival might herald some sort of inconsistency that doesn't allow businesses to plan, consumers to feel good about spending money, and so forth. And really, that came about as those forces started to appear in economic data. And of course, we start with the S&P Global PMI numbers that, as of January, February, show us that the economy is starting to rapidly decelerate. Now, these are preliminary figures for March, where we saw a little bit of a bounce. We've already seen the final one for the manufacturing side released earlier this week. Perhaps there'll be a little bit more of an adjustment up or down, but what we see here thematically is the most important thing. Clearly, the economy was looking very strong in the final 6 months of last year, powered by a buoyant service sector. You can see here, services powering ahead. As ever, these charts are in terms where 50 is neutral, above 50 is growth, and the further you go above 50, the faster the growth. Below 50 is contraction. The further you go below 50, the faster the contraction. So we can see here, first and foremost, services are what matter, because the composite index that takes in both services and manufacturing really just follows services. Moreover, manufacturing can be in contraction territory, where it was most of the second half of last year, and the economy can power ahead all the same because it's services that's pulling it. Then this occurs at the beginning of the year, and this is where the markets get upset, because it's showing that uncertainty around fiscal policy, and tariffs more particularly, is starting to weigh on business confidence and in expectations for economic activity. And that activity slows dramatically. It has since, again, rebounded a bit if these preliminary readings hold, but nevertheless, there's been a clear level change, even if they do, to a significantly lower level, and it's happened in the service sector, where you're not necessarily impacted by the tariffs directly, which tend to impact goods trade, not services, at least in their direct impact. But the real issue here is sentiment. And the idea that the way that the tariffs are being rolled out, and the way that fiscal policy more generally is being rolled out, is not giving businesses a level of confidence to plan forward. This is really where any of this becomes a concern. It's the same story in consumer confidence. You arrive at a place here where, again, really February and onward, consumers start to see the rollout of the tariffs, the rollout of some of these other policies, and we can see that there is a surge in inflation expectations back to where they were just at the peak of the inflationary cycle in 2022, and consumer confidence craters in its estimation primarily of what's coming next. The assessment of the current environment, not great, not moving in the right direction, but not anything scary. But the overall sentiment index is getting pulled significantly lower, back to levels unseen since the second half of 2022, largely by this drop, this aggressive decline in expectations, which itself, not surprisingly, is linked to the surge in expected inflation. And lest we think that this is all just a collection of individual points in the sort of flood of macro data that we see, consider the Atlanta Fed GDP now forecast, not for its levels. I mean, currently, certainly it looks quite ominous, where even if we factor out the disruptive influence of gold imports, which have according to the Atlanta Fed, been an outsized downward sort of catalyst here for the overall model and the way that it's constructed, even if we sort of predict the model looks more like this. Nevertheless, we are looking at growth for the first quarter that's deeply into negative territory and in excess of negative 1%. Now, should we get married to this number? Of course not. It'll be quite a while yet before first quarter GDP numbers come out. But the important thing is the trajectory of the line here, which reflects real-time inputs from incoming economic data. When the data comes out, there are regular revisions. There was a revision yesterday. There will be another one tomorrow. There was no real big splash U.S. economic data today, but PMIs and ISM came out yesterday. There's more of that tomorrow. We'll see another revision, but this model is revised very frequently. And so the real takeaway here is the tone of the data that's been going into the bucket. And the slope of the line clearly tells you the overall thrust of data input into the model has been exceedingly negative. And so this is really why all of this is so dramatic. It is about the uncertainty of implementation and what it means, less so the substance of tariffs as such. So then we have the announcement. And what has been the market response? Well, not great. Initially, we get a pop because it seems like what we have is a 10% across the board tariff, which would, of course, give the markets the kind of forecastability and businesses and consumers the kind of forecastability that they've been pining for, hence the positive response. But then there is a clarification saying the 10% is a floor. And above that, there will be a diverse range of levels across various countries. And this is the table that we ultimately get from the White House and that the president presented. Now, beyond looking at individual rates, because that seems hardly the main takeaway here, the real issue is how many of them there are and how disparate they are. Because in setting individual rates across all of these countries, what we essentially do is open the door for negotiation. This looks like an opening bid to discuss these levels with the countries that are above 10%, say China, European Union, Vietnam. And from that, to reach some sort of new agreement and to bring these levels down. But of course, what that means is that these levels are subject to change. And if the experience of Canada and Mexico that gave us all this consternation in sentiment that we just discussed to begin with, if that's telling of an example, then we're going to be seeing very rapid reversals on a lot of these back and forth. Especially since this is being done through executive action, and so can be flexible that way rather than, let's say, an act of Congress, which goes through a lot of deliberation and is difficult to do, but then also to undo. And so if the markets were after certainty, that's not what they got here. They got a recipe for continued uncertainty while these negotiations are taking place. You see a similar response in the bonds. Initially, bonds come in, and then once it becomes clear what the tone of the conversation is, they surge. Volatility futures, initially down, then surging back to their recent highs. This is the current front month contract for VIX futures here. And so what we're looking then to see from here is the extent to which these moves hold, because clearly the initial reaction has not been more certainty, it's been less. which is precisely what the markets didn't want to see. So when we open tomorrow, the likelier scenario seems like these moves carry forward. But of course, this is where economic data comes in. If the economy is doing relatively okay, then this impact will be more digestible. If the economy is already looking weak, as the sum of the survey data that we just looked at implies, well then, that makes this that much more damaging, and that makes the uncertainty around this that much more of an economic headwind. And with that in mind, the focus turns to ISM service sector data, which very pointedly has held up better than the S&P Global version. So just to check in here, this sort of spook that we saw, which has clearly spooked the markets as well, it has not shown up yet in this ISM version of the PMIs. Now, we did get the manufacturing numbers earlier in the week. They were a little bit worse than expected. The expectation was a slight contraction. We got a contraction at a slightly faster rate. The key now then is what happens with the service sector, because again, this is the lion's share of the economy. And if the negative sentiment from this policy implementation fog that has enveloped investors here, if that already shows up in a disappointing service sector number, which looks like it'll only cool a little bit from 53 and change to 53, then the level of concern in markets really ought to multiply. And of course, the calls for the Fed to rescue investors ought to grow louder. Because indeed, as we consider what the market's release valve is on all of this, it seems increasingly that it has become the Fed, much as it typically happens when the markets perceive some sort of incoherence in fiscal policy, and then, much as they did, for example, in the aftermath of the 08 crisis, they turn to the Fed and go, okay, well, obviously the environment is difficult. You're going to have to give us cheap money as cushion against all of these headwinds. And so as a consequence of the response that we saw here and here, we, of course, see a significant dovish revision of Fed policy expectations that as of the close today, and this might get more revision tomorrow, are calling for 110 basis points in easing this year and next in total. And we can see the markets are tilting toward front-loading that. That's a little bit different than what the Fed has. The Fed had 100 basis points in its latest forecast, from 4.4 to 3.9 this year, then to 3.4 next year. That's 50 basis points this year, 50 basis points next. In some of the markets, they're not too far apart, although they're starting to lean in a more dovish direction than the central bank itself. But the makeup of the way that these cuts are meant to arrive looks like they want more of them now because the growth scare is more imminent. With that in mind, if this ISM data, with the benefit of everything we've just seen and the tariff situation at least off the board as a event risk, not off the board as a risk, of course, because inherently what this means is more uncertainty and therefore more back and forth on incoming headlines. But at least with the event risk of the announcement out of the way, the question then becomes, well, how readily will the Fed come to the market's rescue? And that is very much a function of whether U.S. economic data beckons them to do it. We heard from Jay Powell at the press conference following the last FOMC meeting that the Fed is concerned, much as the markets are, but it needs to see the pain in hard, quote-unquote, data, not just surveys, in order to get to going. And so when we consider this ISM data. It is, of course, a survey, but it would be another brick in the wall of evidence that the Fed needs to see. And of course, if this misses and starts to show the consternation that S&P Global has already been calling out, well, then the Fed has a much better case on its hands as we go into NFP, that's Friday, and Fed Chair Jerome Powell's speech on the economic outlook that follows just a few hours after. So the release valve here seems to be the Fed, and the direction of travel then becomes, if the Fed is dovish enough, or it isn't. That's what stocks may hinge on. But either way, the path of least resistance for bonds now looks like it points higher still. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I'll be on with Chris for Futures Power Hour on Friday, as I am every Friday and Monday. I'll be back with Victor Jones next week on Tuesday, as I am every Tuesday, for The Price of Truth. On with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, Dan Cecilia. And keeping with the trend, Dan, it's Wednesday interview series. So we've been talking to traders recently off of X. We have no stranger to Tasty Crypto. We've done some spaces with him on X before. We got Boss Imp of Strike here today. Boss, welcome to the show.
Thank you, Ryan. Happy to be here. Looking forward to the discussion. I think the market have been exciting, and we have a lot to talk about today.
Yeah, absolutely. Keeping us on our toes. I think everybody probably assumed you'd get some sort of rally, a big bounce at some point in time. Last week has been challenging, I think, to say the least, not just in crypto, but across equities and many different markets, feeling the pain and volatility at levels that we really haven't seen all that often in history, which makes it fun from a trading perspective for sure. We're going to talk alpha opportunities, on-chain options, your journey a little bit. I think you've got a really interesting story here that I want to dig into. But before we do that, let's just get right into it. How are you thinking about the markets at this stage?
Honestly, today I was talking like in Telegram, and I was saying I was expecting a rally either this week or next week, because for me it was kind of a bluff. Not a bluff, but like leverage this whole rally, this whole tariff discussion. What's coming is a bit more... It's a bit more of the surprise. We're going to see a rally on equities to some extent. They've been oversold for crypto. It's another story. We've been seeing like a lot of BTC dominance keeping strong. What's going to be like the risk appetite of with the ETF, with the institution in the US notably. We have been all a bit disappointed with what came after Trump, price action wise, but there have been in the background a lot of improvement. And I don't know, personally I've been seeing a lot of people saying bring Gensler back, etc., but I think they don't see how the regulation is moving, and we're getting an adequate regulatory framework. There is a lot of lawsuits that were dropped. There were nonsense that were dropped. We're going to get like a really nice sandbox to potentially play, and it's the moment for builders to come and to build and to get us like those new use cases and to integrate them and to take potentially crypto to mass adoption. So we should be excited about that, not just about price action. It's more about like the whole like environment and how with the adequate policy we can push crypto overall.
Yeah, that's what I'm interested in myself is just to see how this evolves. You know, do you get this kind of DeFi renaissance or DeFi 2.0 given a shifting regulatory backdrop? But in no way am I advocating for bring Gensler back. I have not seen that, but that made me chuckle.
No, I've seen it
bit.
in groups. I've seen it in groups. It's memes, but people are really like traumatized by the recent price action.
Did you expect the move today? Did you expect kind of this pause or this like relief that we saw today? How were you positioned for it?
I wasn't expecting it today necessarily. Like last week, I think Friday, I bought some butterfly for Monday and for Friday. And the Monday one I sold at a small loss. And the one for Friday was I think it was on QQQ. It was 450, 460, 470 butterfly, and now QQQ shot to 467, I think, something like that. So I closed that one and I opened the one a little bit higher because I think the move is going to continue. But yeah, I was expecting. So I was positioning for this explosive rally, especially after what happened yesterday. I knew like the moment we were gonna get a relief, we're gonna get harder. I wasn't expecting it today. I wanted to buy spreads and to get exposure to that. If you want a little bit more down, I was waiting a bit. I was as the week passed, I was most thinking the next week. But yeah, you never know, and it happened today. So, but I expect continuation, so I positioned a bit for it, but we'll see.
Yeah, I would think the same. I mean, after just the size of the move here today, obviously volatility is still a bit elevated. Maybe we see some follow through. Don't necessarily think we're out of the woods just yet. I mean, we got a 90-day pause, and I think the big relief is obviously on the back of reciprocal tariffs across the board going to 10% versus some of the higher numbers that we saw on that big, I don't know what you call it, flashcard or poster that was displayed on Liberation Day. But there's still the 125% increase or the increase to the rate of 125% now on China. So we'll see how they respond.
But that's something to put it in perspective. The US, I think, imports around 440 billion from China and they export 120 billion. So I think like that's kind of unbalanced, and if they cannot just retaliate with tariff, they need to negotiate, and once those supply chain move from China, they're sticky. They won't come back to China necessarily as fast as and giving how Trump, like President Trump, focus is against China, some country may move from China for like, I don't know, Vietnam or Philippines or whatever and don't come back. So China has to be afraid of that, I think.
Yeah, absolutely. I think you probably have a scenario where the U.S. likely has the upper hand here. But want to switch gears. Dan told me earlier today that he saw on Twitter that you had mentioned you took a wallet from, let's say, around 1 ETH to some pretty sizable gains. Everyone should go and follow you on X, first of all, or on Twitter, whatever we call it nowadays, at BossImp75, up there on the screen. But can you talk us through, I mean, you don't have to give us all the details, obviously, but can you talk us through how you did that? How does one in crypto, where you can have sizable gains, obviously, but kind of any approach that you took that was able to get you to those levels? Can you shed some light on that?
Over risk and hope everything goes right. No, but like for that specific wallet, it was the one wallet. Like I aped into some Google form project. I did a fresh wallet with 1 ETH, and it kind of 3x'd it, I think, or 5x'd it. I don't remember. It was back in April or March 2024, and I kept using that wallet, and I kept like, it was when it was the 404 meta, like those NFT mixed with liquidity, and I kept just buying that meta, buying the dips, making 50%, 2x on some dips when like. Honestly, this year on chain, if you do DGM stuff, it means high risk following the meta. We had a few meta this year. I'm not talking about Solana because I suck on Solana, but I'm talking about like Base, ETH, all the EVM chains. If you had like 2 months this year or 3 months, it would be like March 2024 and November and December 2024. You trade only when there is like high liquidity, high volume, and you have a clear kind of meta on chain, and you just grind the groups, you grind Twitter, you try to get into like early into some projects, either early and you can get those big multiples, I don't know, 5, 7, 10x sometimes, or you get into those heated meta when you can buy the dip and hope for a 2.5x, 3x, and really don't watch the volume, and you don't want to be a bag holder. So sometimes you exit early. If you don't feel it, you exit early. You kind of protect your profit. And on the other side, sometimes there is another strategy that I used to some extent, is you be patient. There is a lot of, if you find a project you believe in quality-wise, sometimes needs time to, for liquidity to redistribute, for people to exit, etc. But I've done a couple of projects that they did 10x. All I had to do is wait 1-2 months. But you have to identify quality and to know the right parameters for that. So don't over risk. Try to trade when there is a lot of liquidity around. So, for example, lately I've not been trading at all on chain because I think you're more likely to give up gains. So you trade when the market is moving, when there is a lot of liquidity, when there is easier to make multiples. And then now I've been trading a bit majors, and I'm going a little bit more on equity because equity is majors are now behaving on equity, behaving like shitcoins, basically going up 12% daily. So yeah, I think it's just you have to choose your moment and to get into those groups, to get into follow the meta and follow the liquidity.
Yeah, and on that point, you talk about getting in early projects or just following the meta. Is there anything specifically you do follow? Where do you find alpha?
So before it used to be Discord, I was in a few groups and I would try to get, now I moved to Telegram and I don't like this. Usually I'm a boomer, so I kind of have sometimes trouble to adapt to change, but it took me a few months to get into Telegram bots. Now I've been tracking a little, also some wallets, so mainly Telegram, tracking some wallets, doing some DD. If I see multiple wallets I'm following, buying something, I would kind of DD it a bit more, or it's basically being present. And also in some groups, I tried over time, over years, I met some people, introduced into some groups. Some are paid groups when you have to have an NFT. Some are free groups, and I try to continue the grind and to get into as many. One of my problem is getting information. It's not analyzing information. It's how I get the information. It's always been difficult for me to go to grind Twitter, etc. So I use groups and wallets as proxy for information. Some people are better than me to find information, and I try to exchange that with more knowledge around the markets, around risk management, etc. So they have win-win. Giving me access to some groups or giving me information.
So when you find a wallet that's, I guess you're following a wallet, let's say, and is it simple as they purchased a token, they're getting into something, and that kind of pops up on your radar, you start to investigate it or explore it a little bit more?
Yeah, something like that. And especially if you have multiple wallets you're following that buying, that's a stronger signal. But sometimes you're gonna have a wallet that's just buying something kind of random, and you don't have information on it. So you cannot you can autocopy in theory, but sometimes it's not worth it to autocopy.
Yeah. So sorry, go ahead.
Especially in times like this, if we were in November, I would be a little bit more loose, but right now I'm just very picky about what I buy.
Gotcha. And so switching gears to Strike, you're listed as an advisor there, and you're pretty, you're part of the team. Can you tell us, a little bit more about it and, what you've been responsible for there?
Sure. So Strike was originally the OPEX. It was launched in June 2021. I actually participated in the public sale of the OPEX back then. I was just starting in DeFi, a couple of months ago. So Strike is a decentralized option protocol. Now we are using concentrated liquidity to sell options basically on the CLAM model. So using concentrated liquidity AMM, We can sell options on any assets as long as it has a V3 liquidity pool and people to provide this liquidity. What is smart about this is, as a liquidity provider, we can optimize your yield by selling, we kind of cut or use your whole range to sell options, not only the active part of your range. When you provide liquidity on Uniswap, I don't know, you can provide between how much is this 1.6, you can provide between 1.4 or let's say 1.5 and 1.7. You will have only a portion of your liquidity that is active. When you provide liquidity to Strike, you can sell options on your whole range and optimize your yield that way. We were present on multiple blockchain, Arbitrum, Berachain, Sonic, etc. And we're looking to cover assets that are not covered by big exchange like Deribit and etc. And also we cover ETH and BTC. And my role on Strike, I'm more an advisor on quantitative matters, and a bit of strategy. I was very involved. I was following the project since 2021, and I became friend with the team. And we felt at one point my input was valued, and I was to be participate in product design and work into really quantitative issue. My background is in investment banking and risk management. I worked on interest rate derivatives. I worked on options professionally on equities with risk management optimization software, which had hedge funds and market makers as clients.
So when you look at on-chain options, is there a specific chain where you're starting to see more signs of growth or a concentration of liquidity, or what, I guess generally speaking, are you seeing in terms of the maturation of the markets?
Sadly, on-chain options have not really took off until now. I think it has to be something that I've been advocate for a long time. It's capital efficiency, how you can sell options where being capital efficient and having some kind of this margin on chain. And I think something a lot of options protocol are not exploring is potentially how to get that capital efficiency and also how to reduce fees also. For example, I would like to see a Deribit competitor, something like Hyperliquid, a Deribit competitor that has lower fees. I've been dying to try some sophisticated strategy on BTC, on ETH, but the fees are killing me on Deribit. It's 3 bips, I think, 3 or 2 bips, so it's 0.03%, and it's huge on BTC. For me to be profitable, as if I open a butterfly, I'm instantly down 20-25%. And that completely kills my risk reward.
Yeah, absolutely. It's tough when it's that wide or the fees are that high, in a sense. For anybody that's not familiar with on-chain options, though, I mean, is it fair to say that it's very similar to the experience that you might have? And granted, there's maybe a little bit less liquidity at times, and I think that will improve as we go forward. But is it fair to say that it's very similar to the experience that you would have with, say, a Tasty Trade or trading options as a retail participant through a brokerage firm? Do you have an option chain? Can you use similar strategies regardless of the capital efficiency? Is there still a way to approach the markets that way?
So for Strike itself, you can only go long options via buying them or provide liquidity. You cannot do at the moment selling like spreads or butterfly. You can on some other exchange do it, but the margin, to my knowledge, is not very well calculated and the liquidity is not present. The advantage of Strike is since you can only go long options, you have a small discount compared to what you would have on Deribit, for example, or etc. So you're gonna get that because it's a win-win situation when liquidity provider get a higher yield, but since they guarantee the payoff only if you are in the money, you get a discount. So for you, if you want to like swing and to get like this big leverage at a small discount and you kind of bullish in 24 hours on 1 week, that's the two maturity we have. You can do it. On chain, honestly, for me, liquidity has been very, very problematic whenever I use. So I use Strike because it's a mid price. Whenever I use other platform, I'm gonna move the mid price, or I'm gonna get like this margin problem. So I'd rather use, for example, Deribit or Bybit, even if I'm not a fan of their liquidity. I think the liquidity has to scale, and it's hard because we need to get like some market makers, and the problem, there is not liquidity, so market makers are not coming. So that's why we need like kind of a big push on options on chain to get like a sex-like experience on chain.
Yeah, I kind of think that will probably, I mean, we sit in the US, so we have a bit of a US centric approach, but should we get regulations over time that I think influence activity on chain, that probably has to happen first, but I think it will happen, which I'm excited about. And that's probably another indication of how early it is too, that you don't really have a robust or mature derivatives market in this space. As you've mentioned, there's Deribit, but it's kind of it. So I think, again, another sign that it's early, and while it could be frustrating at times if there's less liquidity, I'm excited about the future.
I'm hoping, because I want to see like this option sector like expanding. It's been only retracting since early 2023, so it's a bit painful to see. We used to have a lot more activity even on chain. I think it has also to come with people understanding perps easier, and options are a bit more complicated. I think the real boom in the US came from retail and from Wall Street bets, and we kind of have that, hopefully, that moment for crypto options at one point. And talking about Deribit, I think Coinbase put a bit on Deribit lately, so that's kind of interesting.
Yeah, that would be really interesting if that plays out.
Yeah, do you have any thoughts on that? Yeah. Like, do you think that's a good thing for the space, that consolidation or Coinbase acquiring?
Yeah. I think like if you can get for me, I'm frustrated with the overall option market, even on derivatives. I need to check. By the way, today, ETH option ETF has been approved, so I want to check the liquidity on that. I think on IBIT it's really good. I need to check on that. Maybe I'll do a little bit more options. But yeah, I think it's a good thing if Coinbase basically since early this year have been taking more risks. And I think they're going to push for being really the flagship of crypto in the US, and have them having options and pushing them to retail should impact also on-chain options, but should impact the liquidity. Maybe the fees also get more actors, be able to do all what we can do on a regular broker on Deribit. That would be very, very nice to me, honestly.
Yeah, just to that point, boss, like you mentioned, coming across the wire here, it looks like 30 minutes or so ago, SEC clears Ethereum ETF options trading for BlackRock and Fidelity ETFs. That got lost somewhere along the way, given everything else that was going on today. But that's huge. That's really exciting. And again, is another step towards, I just think, again, the evolution of this space.
Yeah, definitely. Now we're waiting for staking on ETH ETF, I think, and that would push a bit ETH price higher and get like some traction from boomer that want that 3 or 4% dividend yield on their ETF.
Absolutely, yeah. And I think it's great to point that out because, you know, we look at kind of the short-term volatility, and as you mentioned earlier, you know, there was a lot of excitement built into kind of the post-election price action and the assumption that we were going to see immediate changes, which nothing ever happens overnight like that. But when you look at kind of the roadmap, or you look at maybe what's on the horizon, in a sense, again, a lot of indications that it's still early, right? We don't have Ethereum ETF staking. We don't even have a Solana ETF. And I'm not saying that you need an ETF wrapper for all of these different tokens, but a couple more catalysts that likely sit on the horizon that could certainly induce flows for sure.
For me, I think it's how we see the future and how potentially the newcomers what the newcomers will buy. After like BTC, ETH, Solana is a certainty for me to some extent. Who will win between ETH and Solana? I think they're not really competitors. They're like serve different audiences. But after that, what will stay, what will consolidate, what will emerge. That's the big unknown for me. For example, we can see a development of BTC DeFi. What's going to be the big trend? What's going to be the winners of the Trump administration? That's the big question, and that's something to be looking forward and to try to find it and to place the bets pretty early.
Yeah. Do you have a view on that? Is there anything that you're looking at that you think might be a winner?
Potentially BTC DeFi, maybe, but honestly, I don't know a lot about it. I need to look a little bit more about it. Something like everything that is BTC centric seems like a good narrative, and I need to do more research about it. And to this year, I've been trading a lot. I've not been researching a lot. Now I think it's the moment to take some time and to try to figure out and to be on top of the new meta, or the new narratives, I would say.
Yeah, make sure you share that with us when you figure it out, though.
Absolutely.
Will do.
Yeah, so we always ask our guests, do you have a bull prediction for Bitcoin or crypto broadly over the next year?
I think Bitcoin is easily go to 150K in the next year or something. I won't say 200K, but that's on the table. But I think Bitcoin is very well positioned. When you see, even compared to traditional market, it held very, very well. I think it outperformed Nasdaq on this drop, since from almost outperformed Nasdaq from all-time high drop. So I think Bitcoin is very, very solid, and it should at least go to 150K by mid 2026.
Music to my ears. Yeah. I mean, when you just look at the chart here, it does seem that there's a similar pattern forming to what we saw for, most of, let's call it the March to pre-election cycle there, or that period. And then you had the election catalyst, obviously, and you shot higher. Well, you're kind of seeing a similar, I don't know if you want to call it a fractal pattern, but you're kind of seeing a similar trend in place here. And I think if we can just base around 75, 80, that's encouraging, to say the least.
And we've been distributing a lot of market cap, even the increase from 65 to 110 was very, very fast. And that's adding, I don't know how many, 500 billion or something, 600 billion of market cap. So it needs to kind of solidify and distribute and get ready for the next. I think if we made the bottom right now, it's very bullish for Bitcoin, I think.
Absolutely. Well, before we let you go, one last question for you. Any advice for new crypto traders or investors, given you've been in the space for a long time, you got a lot of experience and you've had a lot of success?
I think wait for when the moment, how I was saying earlier, trade when the market is really moving and is really positive. Usually there is a lag between price action for majors, BTC and ETH, and how the on-chain activity goes up. So when the on-chain activity ticks up, you can try on-chain and you can try to understand how things move. Don't over-risk initially, but what's interesting about on-chain is the asymmetry of risk. Is you can lose only 100% of your initial, but you can make multiple X, 2, 3, 4, 5X. So once you get the feel of it, try to get your risk on check and to not over-risk. You don't need to over-risk to make money. But yeah, trade when the market is good, and don't try to over-trade when the market is turning bad or going down or there is less activity. And don't greed, don't it's better to exit before the top than to hold on the way down, and there is enough opportunity for you to make money, basically. But just take time to learn, and it's not gonna be a quick dollar, but if you take time, you can potentially hit it big.
Awesome. Well, boss, we appreciate the advice. We appreciate you coming on the show, and hope everybody enjoyed this interview. Definitely head over to X. Give Boss Imp a follow on X at BossImp75, an advisor to Strike. A lot of good content on his feed. So check him out. Hope to have you back on here as well at some point. Want to do a roundtable. We've had a lot of traders on the show, a lot of people with a focus in the derivative space. So would love to get you back on here at some point as well, boss.
Anytime. Honestly, anytime. Thanks for the discussion, guys. I hope I didn't talk too much, and it was a pleasure, Ryan and Dan.
You're great. Yeah, thank you very much, and we'll talk to you soon. And that's going to do it for our show. We will be back on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at tastylive.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
James Blakeway, Carthage College. Number 25, my percentage profit target for straddles and big lizards.
Tracy Aljo, Ohio University. Number 21, because that's how many people have asked me if Tom's hair is real. It's real, ladies.
Katie McGarrigle, University of Illinois. Number 44, because I like to trade underlines with an IV rank higher than 44.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Stephen Atlanta, thank you so much for holding.
My pleasure, guys. And let me go on record as saying I think you've got Tasty Trade is the best brokerage, and you guys have the best content, and I'm not here just schmoozing. Y'all are the best on the planet, period, for what you do. Go on record as saying that. Tom,
Thanks.
You were the great disruptor when it came to forming Thinkorswim and then Tasty Trade. You're an innovator.
I appreciate you calling in. Good stuff as always. Thanks, man.
The beauty of Thinkorswim was that we were different. From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building. The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do.
I tend to call myself a lonely options trader because I really don't have a lot of people that I can share stories of wins and losses with. Like Tasty Live plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And Tasty Live has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
top weekly recap.
Well, we got no Vanetta today. She's out on a secret mission. Is this correct?
She's on a secret mission in New York City. But yeah, we're doing a funny little promotion, and we're going to see how it goes. And there's an outside chance, very small chance she gets arrested. Yeah.
So you guys sent me to New York to deface a national treasure, and I did not get arrested. No, in partnership with a testicular cancer charity, we mounted cherries onto the back of the charging bull on Wall Street, and it was awesome. We did a test run last night at midnight. People went nuts for this. Some guy yelled at us, and this other guy was like, oh, he's just cranky. But it's all for a good cause. We're out there for a couple of hours. It took months of planning. It takes 2 people to hang them because that bull's ass is pretty tall. So that's why I'm in New York.
Those cherries got some good hang to them.
Mm-hmm.
Yeah.
Friday might be interesting. I'm not allowed to work on Friday. I have committed to my family because the Golden Prince is getting married.
I know. Congratulations.
So I have committed that I have to do family stuff, like take pictures.
I'll take things that Tom excels at for 100, please.
I'm just going to be a good,
attentive husband and father to the groom.
I'm never a good attentive husband. What I'm probably best at is
dancing. I watched you at the last wedding. You really excel at dancing.
I excel at picking up the tab.
My big question for you, and you know Slappy as he's gotten older.
What do you want to know about Steve?
Do you think after dinner, it was his 60th birthday?
No. Don't do it.
Beth knows Tony better than I know Steve.
Do you think he...
I have no idea what you're talking about, and I am just going to move on from this conversation. I'm with Beth. No.
That was like Minority Report, like a pre-crime Omaha. You know, like she knew the Omaha was coming. Like she got the little ball that came down and was like, okay, Tony's gonna go there.
Get the full scoop by checking out the archives at tastylive.com.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
Feel like your wardrobe is missing something like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Here's what your buddies mean when they say to catch a falling knife. Ever seen a stock make a huge move lower? And maybe you had the thought, I'm gonna buy that stock. But then it just keeps going down. That's a falling knife. A falling knife is a stock that makes a big move lower and then continues to move lower. The contrarian trader has the idea to go long that stock in the hopes for a bounce, catching that falling knife. But you gotta be careful trying to catch those falling knives.
On today's Trader Taste Test, we are going to the first Chicago location of Voodoo Donuts. Let's go. Okay, you guys.
Voodoo.
So we got a dozen of the classic Voodoo, and then a dozen of the Voodoo dozen. So.
These are basic.
Basic?
This one.
Okay, that's going to be your taste test.
Good.
How many stars do you give it?
3 1/4.
Yeah,
see, this doesn't work for me. This is for children. That's why there's cereal on top of it. This is my jam. Nice old school donut.
Old school buttermilk.
All right.
It's not a crow.
Okay, what do you rate it?
3.25.
That's sweet.
3 point. I know, because I've trained him how to be a market maker. Now we load up the flotola.
It was a great show, very inspirational and motivating. I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event.
I thought the math would be really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
What happens when two titans of trading come together to harness the power of their prowess? You get a massive display of, whatever this is. Oh, they already had it there. Come on, gents, it's not that hard. Hit the ball with your paddle, mate. Oh, for the love of... Well, lucky for us, Tom and TP are better at writing than they are almost anything else. Subscribe to Tasty Live Cherry Bomb to get piping hot takes on the market, trade ideas, and more delivered right to your inbox. Sign up at tastylive.com/newsletters.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, cover calls, iron condors, jade lizards, become a trading mastermind. Get the guide at tastylive.com/guide. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
Well, we got no Vanetta today. She's out on a secret mission. Is this correct?
She's on a secret mission in New York City. But yeah, we're doing a funny little promotion and we're going to see how it goes. And there's an outside chance, very small chance she gets arrested. Yeah.
So you guys sent me to New York to deface a national treasure, and I did not get arrested. No, in partnership with a testicular cancer charity, we mounted cherries onto the back.
Got the little ball that came down and was like, okay, Tony's gonna go there.
Get the full scoop by checking out the archives at tastylive.com.
Oh, yeah, it's Monday, April 14th, a little bit after 5 p.m. Central Time, the best time. You know what that means, everybody's time for Tasty Live's evening show, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And good God, they're giving people a lot of incentives to chew on out there. More on that in just a bit. Before we get started, let's say what's up to all the people watching out there. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade Desktop and mobile applications. If you don't already have both, do yourself a favor in these turbulent, volatile times. Go get them. But if you want to be part of the conversation on this part of your screen, there's only one place to do it, and that's on Tasty Live's YouTube channel. So head on over there, find the Tasty Live YouTube channel, jump in the chat, and start banging your phalanges and metacarpals, maybe even your skull against your keyboard. Anything to put random ass characters in the chat and spoof the Google algorithm into putting us in front of as many people as possible. Speaking of the people, I should say what's up to the people. Shout out to everybody in the chat already. Cato Prime, how are you, Ben? Catan, laid back trader, a good name, my friend. That's the only way to trade. Just laid back, a cold-blooded killer. Soul Train, what's up? Max Virtual, Big Deal Donuts, Jeremy Wallace, Kimberly Thomas, great to see you again. Adam Green, and so many more. Hope you're having a terrific start to your week. We got a lot to talk about, my babies. A lot to talk about, indeed. Tariffs on, tariffs off, exception, no exception, retaliation, but all the while, risk rallies. Let us get started. My head hurts now. Are you having fun yet? Are you not entertained, everybody? It's the funniest thing, because if you were to tune in to any of the Sunday shows, and this is how it works. This is how it works, people. You turn into any of the Sunday shows, and I hate them, but I love them. I love them as sort of this barometer of sentiment. So I tune in, and I sort of force my eyes open to get through, an hour of the... I don't mean I don't know what Sunday shows you watch. I'm talking about like the Meet the Press and what's the one? What's the NBC one? With what's her name? Welker. I can't remember. Kristen Welker. I forget the name of the show. Anyways, my point is, those are sometimes they're so brutal and they're so thick with sort of like an agenda. But I open it. I'm watching it, and I'm seeing just this horrific sentiment. And Ray Dalio comes on, and he starts talking about seeing something on the horizon worse than a recession. And Kristen references, you mean like a depression? And so, I'm not saying the left tail of the distribution does not exist. And I'm not saying operate in the market with reckless abandon, especially as a sort of a trader. And in a bear market, number one goal is capital preservation, right? You ask the bear for peace, not riches. Otherwise, the bear gets angry. So I think, but my point is that seemed to be a delayed sort of reaction. You know what I mean? Last week, amidst all the chaos, the spike in volatility up to 60, craziness, guess what? Risk actually rallied. And that was like the part that was left out of the narrative. And some of this stuff was up a ton. Broadcom was up 15, 16, 17%. Nvidia 15, 16, 17%. And you have a continuation of that rally today. Look, I'm not saying all is fine, all is well in the world. I'm certainly not saying that. I'm just saying when you get those Sunday shows all over rotating to one side, you might have a short-term washout in sentiment. And at least to start the day, or to start the week anyway, you get a decent little risk rally here. Not enough. I don't know. We're approaching 5,500. We'll talk about that in a second. But anyways, S&P 500 up 0.4% on the day. The NASDAQ up a little bit more than 0.5%, which was, I think, interesting. The underperformer started out on the open. It was completely outperforming all the other indices, up 2.5%. Ends up being the underperformer on the day. The Dow Jones, your grandfather's favorite index, the index full of blue chip, low volatility, sort of politically ingrained, yield-paying equities. Decent performer today. I think Apple had a big part of that, but up about 0.4%. The Russell, the little tiny engine that could, was the outperformer on the day. The star of the show, shall I say. Am I doing too much? Probably. Up a little bit more than 1%. 1.11% to be exact. They're fading a little bit. They just opened them back up. Futures, all of the indices are down about 0.25%. So they faded a little bit after that open. But the interesting part, and I said this, they flamed me in the comments. I don't want to say it was last week. I think it was the week before. I think I said we were in 6,000 plus or minus 200. I kind of think we're in a 5,500 plus or minus 300. And I think we were close to 5,500 then. By the end of that day, we were like under 5,200. And people in the comments of some video, I think it's on tastylive somewhere, I got a lot of play, and people are like, good call. But I mean, these are ranges, people. It's not like when you say plus or minus something, it's not exactly like you're going to stop on the number. But the point is, we had way more vol to the downside than I would have thought at 57, or 47, 48. But the point is, we are back at that sort of value area, that little magnet of a number, 5,500. One has to ask themselves whether or not it makes a lot of sense to start lightening up on any long exposure that was taken in the midst of that crazy volatility from last week. At least on short-term bets, you're now approaching 5,500, which is likely midpoint or fair value at best. At worst, it's a new resistance area. We shall see how the market wants to play this. Vol still elevated, down significantly, a pretty decent vol crush. I think we were 37, something like that, yesterday on Futures Open when we started having that conversation with Tom, with Pete Molmat, with Ilya Spivak. If you don't join on Sundays, by the way, when Futures Open at 5 o'clock Central, Tasty's open. So join us for first call next Sunday at 4:45 Central. I'm not sure if the holiday week is going to impact that this week. /VX, so VIX futures at 26.12. A quick look. Let me reload this. A quick look at the term structure here. Backwardation for a few days. So even with a rally, you've had a kinky sort of structure to the term to volatility. As I mentioned, VIX cash still up there in the 30s, and short-term VIX, the near-term VIX futures contract is still elevated. So you're still, this is not the normal structure of volatility, just for anyone that's looking at this for the first time. Typically, volatility is synthetic time. So the more you give, the longer you give something to go wrong, right? Or the longer you give something to move, the more probability that it can move. So typically, you see the vol term structure actually the exact opposite. Shorter term have or lower magnitude of move associated with them. The more time you give something, you should have higher magnitude of moves. And in periods of higher volatility, you can get these vol spikes in the short month and the short months contracts, and that is the market betting that while we do have increased volatility, that vol will normalize or it will revert to the mean. So you get this inverted sort of term structure. The difficult part with this is it's not something you just go out and bet against with high sort of. Let me be very careful about the way I say this. You have to be careful against betting against an inverted vol term structure. They can last for a while. I've said this on the show, but I think for anyone that just tunes in, it's a nice, friendly word of warning. 2008, I think we saw some sort of inverted or backwardated VIX term structure for something like 60 plus days. And in 2011, I think it was like 70 something days. So these things can last for a while. Headed back here. I actually, before I go to bonds, which you guys know is my favorite topic, I actually want to talk individual stocks for just a second. Before I do, let's see what you guys are saying in the chat. You got to have the sound working on Sunday night. I hear you, Reds. Face the Nation. Thank you very much. Meet the Press and Face the Nation. Thank you very much. Let's see why the bottom is in, obviously. It's sort of that's an interesting point of view. I don't know. I think we've got a short-term low to work off of. I think it's gonna be hard to get down there and test that 4,800. I think that was a decent price to get in at the S&P. for the risk that we know right now. I think it's entirely possible that over the midterm, we work our way back to challenging that 4,800. I don't know that it happens with the speed that it happened prior. And I think it's, what do you believe? A little bit. For the people that are just trading price, this is not going to matter. But it's a little bit of what do you believe? So, do you believe that bonds blew up to 5% because China and Japan were dumping? I don't know. Maybe there was some of that. And I definitely don't want to sort of whistle past the graveyard. Do you believe that bonds blew up to 5% yields because one or two Japanese high-frequency firms blew up and the market sort of just took their eyeballs out on a liquidation? Do you believe that there was sort of a massive deleveraging that occurred in sort of I don't call it complicated, but a professional sort of very leveraged basis trade in the treasury market? Maybe. I don't know that I have that information. I'm sure that perhaps there might be some players out there that have a better, firmer grasp on what it was. But here's what I know. The catalyst seems fairly obvious. But I think a lot of people hate me, man. They so hate me. They so want me to say that X is happening, therefore Y is happening, and then I should be mad at X. And I don't operate that way on any level. And the people make it political. They say, this guy's he's an apologist. He's out there. And all I'm saying is that there's a lot of things happening at one time. And I think on balance, here, let me do an olive branch. I think on balance, the way in which these policies are being handled and rolled out are less than optimal. Like politically, I get all the game theory behind what they're trying to do or prevent and play against. I think you're playing with fire. Even if this is a winning strategy, and that's a big if, that's a big stretch, a huge, humongous stretch. You're playing with fire with this level of volatility in a stretched, over-indebted global marketplace. So that's my olive branch to all the people that just want me to be super angry. But on the flip side, I think big levered trades can blow up, right? People can get caught off sides. And if this happened with the yen carry trade on August 5th of last year, right? And at that very moment, everybody I talked to was like, this is it. This is it. Obviously, all these people borrowed in yen. They took it over. They bought Mag 7, and this is the unwind, and this is it. And give it a couple of days where a couple of levered players blew themselves out, and capitalism and smart market players punish those people for over-aggressive positions. And you could then we'll see what's what. So I think it was probably a combination of a lot of things. I think it was probably smart retaliation in some ways. It was probably firms that sort of blew up, and an unleveraging of a highly levered trade, and maybe some other stuff I don't know. And so, but I also think that anyone watching that is not sort of as read into the internal market plumbing, they just go, because X, then Y. And I don't know, maybe some of that is true, but maybe it was stretched a little bit. That said, that's not an all clear signal. I still think the way this is being played, I think China's not playing chess, they're playing Go. And that's a really that's a little bit more complicated than chess. I don't know, in my opinion. Anyone else? But the fact that they reached out to Europe, the fact that Europe is looking at reducing tariffs on Chinese vehicles, which gives China a consumer, when, remember in the past, the Biden administration and the Biden administration kind of leaned on Europe. At least that was my read. They leaned on Europe to say, you're going to put these tariffs on these EVs. That was my view. I might be totally wrong. And then all of a sudden you get this catalyst, and now Europe is talking about dropping those tariffs. And I think on the flip side, China's talking about providing liquidity to European markets in one way, shape, or form. And we don't really have any deals. We're arguing over whether or not a clear exception that was given to smartphones and semiconductors and things that we deem to be national security, important from a national security perspective, we're arguing over whether or not an exception should be called an exception, or whether an exception is an exception, or whether tariffs are going to come on things that we deem to be important from a national security perspective. It doesn't seem very tight on this end, and it seems we're leaving a lot of room open for negotiation. And in a weird way, some part of me wonders if what's happening right now actually placed China and the United States on equal but poor footing. And I don't say poor footing, equal footing, and then everyone else, it elevates everyone else, because you actually need deals right now. And then you have another country that's able to play your offer with another offer and get liquidity for what it is that they need to move forward. So instead of making them sort of backing them into a corner, which in some ways you do have negotiating leverage with the tariff, you also have negotiating leverage because of the importance of getting deals on the table on your side versus deals on the table on the other. So just in a wild next 90 days. And I sort of said on Sunday, and I felt on Friday, that I didn't think it was likely, possible for sure, I didn't think it was likely we could do any more damage to ourselves on the tariff front in the very short term. In other words, if we've already given a worst case scenario, and then we walk that back, the odds that we take the 10% on the world up any further in the next week, what are the odds of that? That would just be completely erratic. So I thought the odds of that happening were low. And I think the odds of us moving, what's the difference in 150% tariff on China and 175 or 200 or 250? At some point, you've already exceeded, you've already killed the demand for the product for anyone on the U.S. side. They're just going, all right, 150%, I can't make that work for my business, so I'm not going to buy. And at some level, you can say, and people have said this as well, so it's not some unique comment to myself, but at some point, what are you going to say, 1,000,000%? These numbers don't matter anymore. So I thought the risk of escalation on tit for tat was minimal. So I thought from our point of view, it was going to be hard to make it difficult on ourselves in the short run, and likely the probabilities favored announcements that made things easier on ourselves. And when I say that, I really just mean for the market, easier for the market. Now, the risk of retaliation, I think, is live at all times. And I think, the announcement that China was going to limit the supply of sort of rare earth materials to the United States, that's sort of an example of that. But I do think my leaning going into this week, super hard, I think, to make things more difficult on ourselves. Hard, not impossible. And I think many other people and participants probably had that point of view last week. Wednesday on, Thursday on, especially Friday. And I think you can kind of, the question I started to ask myself at the end of last week, really on Friday, was, okay, if that's true, and if it's going to be hard for us to make things worse on ourselves, what would I want to own in this scenario? What would sort of where would the lean be? And sort of my thought initially was sort of Microsoft. And why is that? I think it's just because OpenAI, Microsoft, I think you can look at all these scenarios. I think what we have to look for is strategically important areas of the economy. What are both areas that are probably too big to fail, and what are national security areas that are likely to be protected in tit for tat? And like Apple is a perfect example. What happened today with Apple is sort of this perfect example of a business with tons of cash, tons of bag money, you could say, to run up on an administration and sort of say, look, what can I do to make this go away? What can I do to help shield from a level of uncertainty that is going to make operating a multi-trillion-dollar business across these two countries a little bit easier? And what do? You spend a little bit of time at Mar-a-Lago, wham, bam, thank you, ma'am. You get a nice $3 trillion in market cap after an exemption that we won't call an exemption is announced on smartphones. And, I don't know about you, but when I think of strategic importance to Americans, when I think of like what I can't live without in an escalating trade war and a potential in an obvious Cold War, and when I think about the small growing left tail risk of China actually moving on Taiwan, which forces some sort of military back and forth, when I think about China sending 150 troops or whatever it was over in the Ukraine-Russian conflict, you know what I think? Man, I hope somebody does something to make sure I have my smartphone. That was kind of my first thought. I don't know about you guys. It definitely wasn't food. It wasn't electricity. It wasn't energy. It wasn't, it wasn't any of those things. It was, man, I tell you what, I bet I got to have, if things get rough, it's my iPhone. Got to have it. But I don't know. That's what happens when you got hundreds of billions of dollars in cash that you didn't really repatriate, even though you said you would. And, here's where we are. I don't know. Maybe that's too negative. I shouldn't have said that. They did repatriate some funds, and they did promise $500 billion investment in the United States. So maybe I'm going too hard in the paint. But the point is, good for you. Found money for Apple, up 2% after getting above 210 and fading to 201. But this is the sick thing about the market, man, is I feel like a bunch of people are going to feel good this week about risk. But the irony is, it's like, yeah, Apple already rallied to $30, and now you feel good. NVIDIA got down to $90. Less than, what were we, 86? $86, and now it's 110, and now you feel good. And when a few weeks ago when we say on this show, like, just pick a number from like the market perspective, pick a multiple you like, pick an earnings discount that makes sense. I started with a 17 multiple on a 10% earnings discount. And then play poker from there. And that's the wild thing, is throwing chips down when everybody's like afraid, and this is the end. This is the end of capitalism. You know, maybe betting on the end just never ever pays. It very rarely pays. But here's what I will say: it was really hard last week because I think for most of you, and I made this joke, not most of you, for most of us, when things are going crazy like that, you want to be protective of capital. So, how would you get upside exposure in a world where where a lot of uncertainty is exploding? You would go and you would use a capital efficient instrument. You might go in and you say, look, I would like to get long a little bit of risk here, right? And the difficult part about getting long a little bit of risk is they were charging you through the face. You know, it was a total shakedown in vol. So how are you going to buy upside call spreads, for example, minimizing your downside risk, keeping your risk defined when you're paying a 50 vol to do it, or more, depending on the vol of the individual instrument? It was just really tough to do it. And even if you did it and you got paid, the tough part about getting paid, especially today, is you get this massive vol crush that steps on the delta aspect. So directionally you got it right, but then they took out the vol, which takes out some of the premium on all your long options, and that makes it difficult, and that's a trade-off. So sometimes, and what I like to do, people know this about me, but I actually I'm almost ashamed to admit it, Tasty, I buy stock in periods of sort of high volatility, and I'm scaling into positions that either I have or I like. I throw dollars on actual stock. That way I'm not paying some volatility premium. And as long as I'm staying really, really small with the exposure, like I generally don't jump out of the window and go, this is the bottom. I just look for prices that might be interesting. Now, I'm sort of talking like we're out of the woods, and I want to be very clear. I don't think that's the case. I think we were in a little pocket here where it was hard to do more damage to ourselves from a headline point of view. And I also think what's going to be really interesting about this earnings season is we're probably going to see a lot of really good numbers. This is the funniest thing. I think we're going to see a lot of really good numbers that beat expectations in many areas of the economy. Maybe not some areas of consumption, especially the lower end consumption. But I think it's entirely possible we see some really good numbers that beat, and they couple it with just a complete couched future guidance or removal of guidance altogether, like we saw from Walmart. I think that's, and then, you know, from an investing standpoint, or for somebody that wants to get a read, you're going to get a balanced sandwich. You know, here's the part that tastes good. We killed it last quarter. Here's the part that tastes bad. We don't know what's happening here, and we don't have any good things to tell you about the next 3 months, which is what you probably care about, or the next year. So I think analysts, for whatever they're worth, who knows if, you know, they're always so late. So if you keep getting these mixed messages, how much do you think they're going to rush to go cut all of their earnings guidance, especially if they think monetary policy easing is on the way? Me personally, I don't think, even if you think this is a 30% haircut to earnings over the next 12 months, something in that ballpark, I don't think you're not going to get that reflected in people's assumptions so early. It takes a while to beat it out of them. So I think at best, I think they start with a 10% haircut and some multiple on top of that. Let's see here. Let me read some of your stuff. Bear market rally says subs. I think so. I do think that 4,800 is a decent low to work off of for a while. As I said, I think we're going to test it. I just because we got there in 3 days doesn't mean we need to get back there in 3 days. Apple 210 is a pull, so an excellent place to add to a current position or start a new one, says Kimberly Thomas. Sub-Zero says, I would do a collar. Victoria says, thanks for going over the subject, Vic. As a new person to options, was very expensive, loved the volatility, now getting cheaper but slow. For sure, Victoria. And that's sort of the interesting thing about dealing with options is you have sort of multiple dimensions that you're trading. It's not just price anymore, right? If volatility was constant and you just had to trade price, that'd be a hell of an instrument that we would get the opportunity to trade. But instead, when stocks get cheap, people's fear and their levels of uncertainty, their distribution gets wide. Because that distribution gets wide, options get more expensive. And betting on the upside may work, but as the upside gets realized, the distribution comes back in, which means the price of those options, or the vol, is getting taken out. And that's the game. It's a beautiful, sick game. Ivy's always the plug in the Black Scholes. Guidance. Where was your first statement? Oh, no, I can't find your first statement, but yeah, I agree. Less guidance. Good numbers, no guidance, says Kyle Hammond. Yeah, I think that's probably true. Mostly, I think some will couch guidance. If you're in a consumer business, I don't know if you just pull guidance. I think you probably get more conservative with guidance. I think there's going to be some businesses that will just pull guidance altogether. Some will sort of want to set realistic expectations for the market. And they may, because you want to do it, I think you probably want to do it now, right? There's vol now, but there's some sense of, we're still at 5,500, 5,400. Seems like the market swallowed a lot of volatility. One individual company is not going to cause the market to crash that comes out and says, hey, we're lowering our guidance by XYZ. But if you don't do it now, and three months from now, you have an environment that has softened, and you're telling everybody you missed their expectations, you're going to get punished. So it's just, what level of confidence do you have that the world that you saw 3 months ago when you guided, what level of confidence do you have that the world you're in now matches that world? And I'm guessing most people, I think most things have changed for them in a way that they would want to reset expectations. Ben says, I plan on listening to earnings calls, but not trading any earnings. Interesting. I don't know. I'm a degenerate. I like binary bets, not a ton. To me, it's just like throwing chips down. And if vol gets interesting, and by the way, I'm a little bit different, I guess. I'm the black sheep of this family. Even when I bet this stuff, I don't bet with undefined risk. So I usually take directional calls. Usually those directional calls are mostly short vol, but they're risk defined. All right. How do you balance a sandwich? I know that was. That's a good point. I should have used something other than a balanced sandwich. I've yet to see a message. I hear nonsense. Oh, brutal. You talking to me, Kyle? All right, I think that's most of that. So let's continue, my friends. With bonds, a nice rally. Again, I think a little bit of a low to play off of. And I last Friday bought some calls and call spreads in ZB. I leaned a little bit long. I went on the show with Tom Friday morning, and I talked about that. I was leaning long bonds, leaning long stock, picking up some tech stocks. Why? Is it because I'm super jazzed about the fiscal situation of America? No. It's because I think everybody thinks they know what last week was. And I think this is not, don't trade like me. But I think when everybody thinks they know exactly why yields went to 5%, and they know they can extrapolate that out to exactly what happens next, you almost guarantee everybody's wrong. Or at least the reflexivity of them being right leads to an opportunity to bet the opposite direction. It's one of the two, and it doesn't really matter. So again, because I think it's hard to hurt ourselves. I think crazy people, they could look at bonds at 112, 113 and go, okay, maybe there's a few points upside here. That's it. Maybe at 115, that starts to get a little bit harder. But you got through the auctions. The auctions were fine, Everyone's afraid that you're just going to show up to a treasury auction and nobody's there. There's no takers. And that's always the risk. There always is that fear in the back of participants' minds, but that didn't happen. And the CPI was cooler than expected. And, the more interesting thing, I think, is that sort of that tax cut moved forward and bonds aren't puking. Obviously, it was priced to a large extent. So I don't know. I like the bet to the upside. I think at 115 to 117, that's probably what this thing has got to the upside. And so for some people, they don't like that risk and reward. For me, I'm a degenerate. I'll take a few points in either direction. So that's the way I'm leaning these things. Ultimately, do I think yields go higher before this is all over? Yes, I do. I do think yields go higher. Do I think they're going to go higher this week? No, I bet they don't. I bet some vol comes out of bonds. I bet we sort of normalize, move back towards mid-range from 112 to 120, from 112 to 122. We move closer to neutral, just because. And that's not the greatest reason to place a trade, and I'm playing it so super short term. But I like the action here to play off of this as a low and sort of my max risk, and where I would have defined risk in if we break to the downside again. But I think if you don't love that, you just wait out a potential rally for a few points to the upside, and you look for a sort of a better position to bet against this area in the marketplace. And I just think about it from. Did I miss the part where we look at the yield curve and coefficient? And that's my favorite part of the show. No, we didn't, Demi. I'm about to do that. Think about it from a person who wants to invest in U.S. debt. Okay. You're going, okay, I have no idea what our policies are going to be. I have no idea what the impact to equity prices are going to be. I have no idea what the retaliation of our economic adversaries are going to be. I have no idea what the current status of a current conflict is going to be. That's still in flux. If some sort of event is triggered in equity markets or in debt markets, I don't know what the Fed response could be. So do I want to go invest? If I have the choice, do I want to bring money to the long end of the curve and lock it up for 10 or 30 years? Or do I want to bring it to the short end of the curve and sort of, have to reinvest on a if you're in treasury bills, you're in something super short term, or maybe you're in notes at 2 years, maybe you feel more comfortable locking up money in debt in the United States for shorter periods of time versus longer periods of time because of the level of uncertainty. And I think in a weird way, I might be told, I think one of the sort of outcomes of that, when you're less interested in buying longer maturities, longer duration in debt, and you would rather own shorter durations of debt, one of the logical outcomes of that is sort of a widening of the 210. There's more demand for 2-year, for treasury bills, for stuff like this. I know that might be a partial misread, but trying to make stuff simple. I'm going to head over. Let's take a look at the yield curve. Again, my favorite thing here to do is show how the curve is moving relative to points in time. So the blue line is, let me start. The red line is where this curve was. And the yield curve is just the yield of each maturity at a point in time. So the red line is where we were when we started this whole cutting cycle back in September. Yellow line is the second, so that was the 50 right after the 50 basis point cut. The yellow line is the second 20 cut of 25 basis points. The red line is September. Good God. Green, November. The blue line is December, which is 25 basis point cut. And then there's a pause. And that pause had really brought the entirety of that yield curve lower. It brought the long end lower, the short end lower. And now, as we get ready to start heading into a period where it seems like we're going to cut. It's just when. I don't know if that's going to end up being true, but for right now, the market is pricing that path. So I'm going to put that path in front of you guys, and we'll go back to the yield curve in just a second. But we're currently 4.25 to 450. And we have a meeting coming up on May 7th. Okay, the likelihood, the market is saying we're going to stay where we are. They're giving it a 1 in 5 chance that they drop rates, but the current odds favor keeping rates where they are. In June, the market has priced the first cut. I want to say the first cut. I'm thinking about these as sort of two different cycles. There was cutting, then there's pause, then we're going to cut again. So you can say just continuation of the existing cycle. 25 basis points in June. Again, in July, another 25 basis points. Hold in September, another cut in October, and hold. So you've got 3 cuts that are currently priced into the rest of the year. And then even when you get into December, you're at basically a 50-50 coin flip on whether or not you'll get a fourth. So the market is, at least in the Fed funds, they're pricing in some decent and aggressive easing from now until the end of the year. And the last time this happened, right? It didn't happen until after the cut, which I found fascinating. It was like the market didn't show the cards. Everyone thought one thing was going to happen. You get the cut, the long end raises, which is the opposite of, I don't know why, but it was the opposite of what a bunch of people thought was going to happen. And now the long end is lifting into the cut, which is different. It's almost as if the long end is preparing for the inflation that comes along with 100 basis points of easing over the next, or I should say a little bit more than 75 basis points worth of easing over the next 12 months. Not 12 months, 7 months. Sub-Zero says, if housing skyrockets due to tariffs, we'll have to raise like crazy. If housing skyrockets due to tariffs, you'll have to raise. I don't get the logic there. If housing skyrockets due to tariffs, the price of an existing home should not change. In theory, all else equal, tariffs shouldn't theoretically impact the price of an existing home, right? But it would impact the inputs on the cost of a new home. And in general, homes are priced at the margin, so at the incremental home sale. So if a new home is built in your neighborhood and it costs 30% more than the last home that was built, it will have a sale price that is higher. But the question is whether demand is available at anything more than where we're at already. I don't know. To me, doesn't it seem like most housing is softening a bit? Are there any areas that are just the real estate is on fire? I don't think that's where we're at right now. I think a lot of places are starting to cool. I think a lot of people might found that they over speculated on homes. They're holding, all these TikTokers, like I've got 100 units. I got this many units. Like, okay, that's fine and good in a strong economy. But if you get a weak economy, especially if you're highly concentrated within a geographic area, and now all of a sudden you can't keep rental incomes in some of those units, or you've got to massively drop those incomes, I don't know. The question is, who's over-levered? Who is swimming without a bathing suit? And that can help to soften up real estate a bit. Home builders, I don't know. What do you think? You put in a little short-term bottom here. XHB was up 2/3 of 1%. ITB, which is another home builder, they got down to 82. They're at 89. Sub-Zero said price for raw materials, limited supply. No. Yeah, I get that. I definitely get that. Stagflation is what I'm expecting. Base case says Sub-Zero. I think I'm mostly in that camp. And the only thing that would sort of make me look for other opportunities is when everybody fully accepts that as their baseline. I don't think stagflation is the baseline yet. It does seem like we're moving in that direction, though. I think, last time there's different types of inflation, and that's part of the conversation that I don't think we're having. There's goods inflation. You had everything inflation last time. And I'd argue through much of ZERP, you had monetary inflation. You had asset inflation. You didn't have goods inflation. It was stealth, but you had a different type. And if it was my guess, because I just put myself in this position, I'm an idiot, and I can't figure out all the pieces, but I try to put myself in that position. I go, what would my incentives be? Okay, I'm trying to measure this. I'm trying to balance both sides as much as possible and get myself to my best outcome if I'm the president. Okay, so I just likely put a bunch of small businesses out of business. Okay, so anybody that runs an online business, an online store that's buying cheap materials, or utilizing cheap labor, cheap manufacturing overseas. I either just hurt your business or I put you out of business straight away. And a lot of those people, if you're a business owner, what do you care about? You care about taxes, and you care about, so the question is like, that's probably his base. And so what are you going to do? You're just going to put all these people out of business and then not do anything about it? Probably not. I could see some sort of relief package coming down the line. Again, this is total conjecture. I'm just thinking through this. You see different relief packages for different people, right? Farmer subsidies last time around, likely this time around. And anyone who's impacted by this tit for tat with China, they got to go through that, figure it out, likely prepare some things to ensure you maintain your political favorability. And that's inflationary, right? And that's money to the people, right? You can send money to the people, or you can send, as Jem Carson says, you can send it to Capital. You can send it to San Francisco. You can send it to Palo Alto. I think that's what he says, not San Francisco, Palo Alto. Which is sort of monetary stimulus. So I think what you're probably trying to do is do as little of the fiscal as you can to maintain your political favorability, but knowing you've got to put some relief packages out there. You're probably trying to get into a world of easing monetary policy. And then the inflation that you would see because of that is going to be asset inflation. So sort of stocks come down, but housing prices go up a little bit, given easing monetary policy and maybe some sort of monetary support, then you're hoping that gets you to a decent place, and then you announce some grand plan for additional some big home building project in a few years that helps to ease the home affordability crisis. I don't know. I'm trying to step through this and figure out what areas might have a decent, might be areas to take decent bets on, or to take a bet on. And I could see if home prices go up, you got a problem, man. You got a problem with everybody, I think. Flip side is 66% of Americans are homeowners. So if home prices go up, as pissed off as the renting class and the non-homeowners will be, you're actually helping more people than you're hurting. Let's see what you guys are saying here. Give me a second. We builders will get hit due to tariff-related material costs, particularly if the market is softening, right? I agree. I don't doubt that. Labor is going to become more scarce. Labor, wow, yep. Don't forget replacement costs. We less home builders and more home makers. And the Fed, so we can go back to single income families. Jeremy, there's a part of me that reads that and it tugs at my heartstrings, this idea that we could go back to the 50s or the 60s where you can have a single income family. You can afford to buy a home. Some part of me, I'm very fond of the idea of that. I don't think everyone benefited equally during that time, but the idea of a single income family and being able to afford a home in a time when the difference between the car, as Morgan Housel writes in his book, the difference in the car that the gentleman on the factory line was driving and the CEO of the company was driving, the difference, the delta between those two cars It wasn't very far. You know? One was driving a Chevy, and maybe one was driving a Cadillac, something like this, you know? So I'm very fond of the idea, Jeremy. But the flip side is ending the Fed would have massive, massive consequences. And I'm not so sure on the other end of that, Jeremy. Here's the biggest thing. I don't know if you get that world. You know what I mean? Because money has already been accumulated in the hands. So much money, which, again, in my personal opinion, I've heard this said, and I really liked the way it was framed. I can't remember who said it, otherwise I give them credit, but it's just a claim on future resources. You know, it's not, I mean, I just didn't hear it. I mean, that's a pretty typical foundation of economics. It's just a claim on future resources, and a lot of those claims are in the hands of a few. So even if you end the Fed, you still got to deal with an issue that all those claims are in the hands of a few. And those are the people that get to negotiate what that system looks like after you end, quote unquote, the Fed. And even if it was some sort of sound money like gold, well, guess what? I've got all the cash now in the system to go purchase the claim on the resource for gold that then makes me a power player in the system you want to go to. So I think the problems are a lot deeper and more intertwined than we want to give credit. I don't know that we, you know, some part of me goes, we're not going back. I'm 2%. Well, Mark, I know that sounds like a straightforward question, but I think it depends on the credit worthiness. Depends on why you're selling debt at 5 and I'm selling debt at 2, and how much risk tolerance I have for the reason that your debt comes with a 3% premium. Home building labor costs might increase too as undocumented workers leave involuntarily. I think that's true. I'll take 30 days at 2%. Jeremy Wall says the unemployment rate is not the same as the number of unemployed people. Amen, bro. Amen. Jeremy, you're going to go crazy trying to prove that point. You might as well just give it up. On one end, I think you're doing God's work, and the more people you tell that to, it's wild that people just, the label is so important. You know, the Patriot Act. What were the other ones? The Inflation Reduction Act, Liberation Day. Like, the labels are so important to framing it up for people. And the unemployment rate, you were right, Jeremy, is not what people think it is. But they use it with this confidence. It's kind of amusing a bit. I think the one thing I probably didn't talk enough about is the news from NVIDIA that they're going to build a plant, start building chips here in America. And I think this is probably going to be the most informative of how a reshoring of manufacturing, what it will actually look like in America. Because I think there's this argument, and I think one that makes sense, right? Moving back manufacturing into America. I think it's likely going to happen for the areas of manufacturing of like the pillars that we find are necessary for national security. I always hate that phrase because it's basically just like the things that are in our best interest. And so semiconductors being just this massive thing that is important for us to maintain some sort of control over. So I think there are these areas, these pillars that we are going to protect, that we want to bring in the supply chain into the United States. And it's not just like, should we be doing it? Could we find a cheaper labor input, whatever? It's like, it's beyond that. It's if we were going to get in a conflict with one of our major economic adversaries, would we have the ability to supply some of the items that we need to supply to put ourselves on the winning side or to minimize our risk as a nation? And the answer for some of those things is unequivocally no. And so that we're going to reverse that. The question, though, for some is, are we really we're doing that really just for national security, and really we're going to open up plants that are mostly or entirely automated to get around the higher labor cost? And while we're selling this as this idea that's going to bring back jobs to America, it will bring back manufacturing, but the type of manufacturing is going to be mostly automated. And therefore it's not actually going to have the benefit to the many who are perhaps more sympathetic to these types of policies. And I think that's the totally fair argument. And I think probably NVIDIA, who said they can get this done in, like, what did they say, 12 to 18 months, something like this, if I'm not mistaken. Yeah. NVIDIA has also been reading from an article in CNBC, just for fair credit. NVIDIA is also building manufacturing plants for its supercomputers in Texas, partnering with Foxconn in Houston and with Wistron in Dallas. The company wrote it expects to reach mass production at most facilities within 12 to 15 months. So within 12 to 15 months, we're going to have an understanding of exactly how many people this strategy can employ. And I think that's going to be a fascinating answer. And I think rather than try to argue with people online over what's true or not, I think 12 months isn't that long to have to wait for that answer. And we're probably going to get the plans soon. All right, I'll end with a few more questions here. Let's see. And then the other thing is, okay, if you can manufacture, you still need control over the entirety of the supply chain, meaning you need the materials. As you've just seen, and we've said this on this show, that we have demand. We are the consumer of and for the world. So our sort of leverage is we're the customer, and we can direct where those funds go. But somebody else's leverage is they're the supplier. You're the customer, but ultimately, if you want to buy it, it's going to come through us one way or another. And so you see sort of one side of this equation is using demand as their negotiating leverage, and the other side is using supply as their negotiating leverage. And cutting off rare earths to the United States is a clear delineation of what's happening, right? Tariffs are, we are going to use our demand to hurt you. Supply restrictions are, we're going to use our supply to retaliate. And I think that's likely what we continue to see here. Which side of that equation would you rather be on? When push comes to shove, and when stuff gets real, do you want to be on the needing of stuff side or the supply side? Anyways, that's probably where the the Greenland stuff and everything else comes from to hedge. If you can afford it, smarter to buy a house when rates are high, which tends to dampen housing prices, and then refi when rates drop and housing prices rise in response. Monthly payments are key. Money wandering, I couldn't agree with that more. Robots need servicing, less people, yes. Better jobs, yes. However, I think we should tax all robots for Social Security. Here's the thing, Jeremy. I don't disagree with you, but let me just, it's this funny thing that will happen. So you're still always dealing with comparative advantage between nations. So if you imagine, Jeremy, that in the United States, you've got a tax on robot labor, what you can do is in India or Vietnam or Singapore or Hong Kong, name anywhere else, right? You can offer robot manufacturing that is tax-free. So now you've got an issue where people are going to open up their robot factories in a different country because they have a more favorable taxing scheme. So I'm not saying I disagree with you. I'm just saying that you gotta think through the global competition too, not just the domestic one. Because if you try to tax for the benefit of Social Security, what happens is people are just going to move. Now, there's a way around that, right? You can just say, you can just tax on the consumption end. So if, let's say, you build a product somewhere, and this is going to get super nasty. I'm not going to do this. I'll do that another time. You just have to think domiciles. We need to be passing the bong around for this conversation. All right, let's get back to a few things here. Gold. It's funny. You got your break, right? A few weeks ago, you got your break in gold, and it just doesn't matter. Anytime gold gets cheaper, they buy it up with reckless abandon, and that should maybe that says something about we're just overpriced. But come on, man, look at the damage they tried to do in gold, and look what happened immediately after. That's not a market that wants to give it up. That's a market that's searching to find supply. That's an imbalance of demand and supply. And for all the, I kept trying to talk about miners, because gold did have an upside, but I just didn't feel like there's not enough two-way action. And if you're not already in the trade, then all you're doing is buying upside calls and hoping for the trend to continue and rolling them higher. Not a bad strategy, not shitting on it in any way, shape, or form. Just like I want bigger bang for the buck. And so what I kept saying on this network was the more bang for the buck is in the miner. You're at all-time highs for gold. You're at a significant discount to highs on some, not all of the miners. And everyone kept telling me, yeah, but Newmont is not, they just went through this M&A. They didn't handle it well. They're less interesting business than, let's say, Agnico Eagle Mines or IM Gold or Barrick Gold. I'm like, yeah, I get it. But if gold keeps climbing, at some point, a rising tide lifts all boats. And Newmont Mining explodes last week like 26%. And guess what? Eventually, you got normalized. We're not at highs, but I'll call $56 pretty damn close. And So yeah, anyways, I'm happy about this one. I'm happy that this one worked. I'm just happy that this one ended up working out. The question now becomes, is it time to fade this thing? I don't know. If you were following this, I think you can't go broke taking profits. Me though, I'd said this wasn't just a short-term play. I want to continue to be in the minors here. It's one of the few parts of the equity markets that are working and working consistently. I think this is a big catch-up trade. Will it give some back? Maybe. But if it gives some back, I'm still relatively constructive. I think Tom is right to be looking at this as a potentially overextended area where you could get those death candles, which are 5% on the downside for gold, which is $150. But they did that a few days in a row the other week. You already got that 120 point, followed by 127 point day, followed by 114 point down day. And I'm giving you the range from high to low. But they did a ton of damage in 3 days. And 4 sessions later, it was trading at new all-time highs. And it's not as if stocks are super cheap here. If I looked at the S&P, and the S&P was, let's call it 4,800, and gold was at 3,300, then I would go, okay, if the market gets a bit less fearful, has less geopolitical uncertainty and more confidence in the U.S. banking system, and just in the U.S. system in general, you could see the fear in the gold market ease, and you could see that capital rotate into U.S. equities or just a risk assets in general. But that's not really. I mean, we're at 5,400. It's not like a lot. Where would that capital go? If you got just a huge puke in gold and it normalized back down to 2,000, where's that capital go? Back in NVIDIA? I don't think it's happening anytime soon. Victor Jones, a couple more. Do the robots retire at 65? At Victor Jones, and that is where the tariffs come in. Yeah, I get it. I get it, man. I get the problem, Jeremy. And I also think when people like Stan Druckenmiller, who are free market people, and they start saying, in so many words, I'm okay. I was okay with tariffs, but not anything more than 10%, because he understands the problem. Like, I don't think this is crazy, the strategy. I just think the way it's being rolled out leaves a lot of opportunity for a self goal. Money Wandering says so-called rare earth minerals aren't that rare. It's just that China has cheaper extraction costs. Noted. Steve Powell says, would you consider property tax being raised 100% inflationary? I'm currently fighting my county in North Carolina along with my neighbors because they are trying to double our taxes. That's the wild thing, too, about holding property as an asset, is that, yes, as we keep printing to do something in response, as we keep printing in response to the crisis that we face, home prices benefit, but then they just jack your property taxes, and the cost of maintenance goes higher, the cost of insurance goes higher. So it's like, how much are you really benefiting? Imagine. This all started with 2% tax from England. And just think about how much wealth gets extracted. All right, people. Somehow this is I like the gold silver ratio. So some part of me, even though I like gold here still, I think at some point silver, I get the reason for the discount in silver because gold is rallying, I think, and a vote of a lack of confidence in the U.S. system, and silver as a more industrial metal doesn't deserve that premium. So if we're about to go into an area where you expect a cyclical slowdown, less growth, you probably, from a demand point of view, you wouldn't get super excited about silver, but you would, as a hedge, want some gold as an alternative to treasuries or as a sort of alternative to the U.S. banking system on your super left far of the tail. So I understand that premium that's being built in the gold silver ratio, but I do think like staying mechanical here and trading the relationship is probably a decent bet that you get a little bit of catch up in silver relative to the price of gold. I like that one. I think if you weren't on the miners train, you probably missed a lot of it last week. I mean, anything that was relatively cheap, they came for it, and they all repriced them 15, 20, 25% higher. So I think the incremental dollar in the miners at this point is a tough bet. I think they gave you a lot of time, and they gave you a lot of discount. I think an incremental dollar here is tough. Me personally, if I didn't have a dollar invested, I'd probably be waiting for a better price. Or I'd play the same game that people played with gold, which is upside call spreads, and you roll if you get it right. And then if you're wrong, you get a nasty reversal. It's not going to be painful. But I am not pitching my miners yet either. So I don't really see a reason to pitch this stuff. And I used to be the guy, if you gave me a 10, 15, 20% move, oh my gosh, that's a gift from God. I'm taking it. The older I get, the more I try to let these things ride a little bit. I'm getting a little bit more, I don't know if I'm getting more greedy or more patient or both. But because it is a stock position, it's not an option position, I'm going to let it go. I'm long bonds, the 30-year, not because I love it, but because I just think maybe we got a couple of points. I think we could end up seeing a little bit of normalization. I think the projection everyone was so sure about last week, I think there's room for that projection to unwind. And I'm still leaning net long in the portfolio, though I do think at 55, this is probably, this is not we have to see whether this has become the new ceiling. I thought it was still fair value where 5,800 is still in the cards. I would probably operate that way, that we could creep higher another couple hundred points, who knows, with the right set of announcements. I think that's the most part. I think I do want to have putting tiny chips on home builders. I know that sounds absolutely insane, and I think there's a lot of pain to come. But because I don't know when the bottom will be here, and because I think I'm starting to get a decent price, I just want to start building a position. I think home builders are they were the first to reverse in 2022, and they went on a 2-year rip with really low variance. So I think the lower and lower some of these things get, the small, I can't emphasize enough how small this is, because I do think there's more pain to come. I think rates ultimately end higher. I think this could be, painful to digest all of this stuff. And their only hope is to digest it slow. You don't want all this pain to come at once. If you do it slow, you got a shot. So yeah, that's where I'm at. Those are my key themes for now. I'm still working on sort of the builder theme. And I'm working on the strategic importance theme. I think those two, if this goes to hell in a handbasket and correlations go to 1 and we go to 3,500 in the S&P, these themes don't matter. But if we end up moving in a direction that is a little bit different than what people are expecting right now, then the themes will matter, or at least having these themes ready to go will matter. So strategic importance, what things do I think are of strategic importance that need to either be protected, subsidized, or exempted on the tariff front? You're seeing some of that play out already. And then I think if we do need to start building, NVIDIA's manufacturing being point number 1, right? We got to move dirt. And who benefits from that? Where does that money go? Some of that money, some of those themes are already moving. So by the time we talk about it, it's going to be a little bit late, but I do think it's a worthwhile conversation. So those things I'll put together for this week. But just giving you a heads up, that's the way my brain is thinking. If you have any ideas along the lines of strategic importance, a theme based on strategic importance, or a theme based on moving dirt, feel free to send those to me. Have a conversation at Victor Jones. The O in Jones is 0 because I like to be difficult. You can also email me directly, victor.jones@tastylive.com, if you want more of a sort of a private audience. I appreciate all the people that have been tagging me and stuff on Twitter, or the people that have been sending me emails as well. It doesn't really matter if you agree with my point of view or disagree with the perspective. I think the engagement is what I prefer the most, and I like learning from everybody, especially the Tasty audience, who's so brilliant and comes at angles from all walks of life. And so I find myself, ironically, the beneficiary of all of your experience. So I appreciate the engagement. Again, at Victor Jones, the O in Jones is 0 because I like to be difficult, or victor.jones@tastylive.com. If you didn't get a chance to go to check out last Thursday's episode, I'm Sosnoff, proud of I thoroughly enjoyed the conversation as well as the topics. It was for the first time in a long time, don't ask me why, that some portion of my conversation was actually posted on YouTube. So you can actually watch it. Imagine that. I'm going to drop the link for that conversation in the chat now. Here we go. So if you haven't watched it, feel free, use that link or share that link if you could. If you enjoyed the conversation, feel free to share it on your social media or email it to your friends. It's about 20 minutes of the full 90-minute conversation, but I thoroughly enjoyed it. And if you didn't see it, I think it's worth the 22 minutes of your time. I will see you back here tomorrow, I think, with a conversation with Chris Vecchio. Chris is going to be Tuesday again this week, and Ilya is going to be Wednesday, and I'm super excited for that. Thanks again. I'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Till then, peace.